喂喂。喂喂。Hello is the visuals and audio too, and the visuals and audio too. Can anyone hear me clearly? On the screen. If the visuals and audio are okay, please type a 0 in the chat room. Oh, good morning, Gura. Good morning, Castros. Yeah, good morning, everyone. Let's start today's live stream. Welcome to Weebearn, which helps you grow rich. We are a comprehensive money educational platform dedicated to nurture entrepreneurs, investors, and capitalists among secondary school students, cosplayers, and anime lovers. Today is our 7th live streaming in English. So let us introduce our channel. Weebearn literally means an otaku money-making channel, 毒撚賺錢會, a platform designed to facilitate financial gain, make otakus great again, and make weebs rich again. In today's market reading, AI Miscellaneous, we're going to read a short paper, Algebraic Interference, from Discrete Nabla operators to quantum field divergence and real-time spatial compression. And we're going to share some financial management opportunities brought about by China's DUV Photolithography and how to trade electricity power. The initial segment of the discussion invites dialogue on data analysis related to savings, as well as an examination of financial reports, macroeconomic indicators, technical aspects, and exchange benefits, thereby elucidating pathways to wealth creation and success. Furthermore, a brief overview of our financial education offerings within the metaverse, personal development courses, live advisory, and live coaching services offered by Weebearn, 毒撚人生顧問同毒撚人生教練服務. The Otaku money-making channel is provided. And if we have time, we're going to share with you a recent update from Vitalik Buterin regarding regarding the cryptographic obfuscation protocols. Additionally, we are going to introduce our United Empires of Otakus, also known as the VTubers Alliance, a decentralized autonomous organization focusing on supporting the development of aspiring virtual idols of the future generations. We encourage participation from interested secondary school students or teenagers looking to embark on a VTuber career. If you are a secondary school student and you are passionate about being a VTuber, join our Weebearn VTubers Incubation Program and Auto Agency. This broadcast presents the installment of our newly established series titled Reading Discussions, or 讀撚讀書會, signifying a reading group format oriented towards wealth creation literature. Our discussions aim to encompass a diverse array of resources ranging from philosophical texts to practical trading manuals, all fostering an understanding of interdisciplinary financial theories and foundational wealth-building logic, ultimately guiding participants toward establishing passive income streams. The motivation behind initiating this reading series parallels the reasons for engaging with artificial intelligence topics. The recognition of a correlation between wealth and reading habits based on statistical studies, coupled with our team's market research revealing growth opportunities for reading. reading discussions, live streaming among peers within the VTuber industry. We acknowledge the importance of literature reviews in developing effective monetary strategies, reinforcing the necessity of standing on the shoulders of giants to uncover principles or strategies for financial success. We are committed to fostering a comprehensive wealth management educational platform aimed at nurturing capitalist entrepreneurs and financial successful individuals among next generation's cosplayers, VTubers, and anime lovers who are studying in high schools or elementary schools. If you enjoy this episode, please subscribe to Weebearn on YouTube and share our videos with your friends and classmates interested in anime, macroeconomics, gaming, AI, cosplay, technology, and options trading. Recognizing that this is our first few times live streaming in English and acknowledging our limited proficiency in English regarding some important and critical money management concepts, we'll recap in Chinese. References and bibliographies to pertinent financial literature, research reports, and theses will also be shared in the comment section in our live chat room for collaborative reading on AI engineering documentation. In our previous live streaming last night, we've introduced the money management insights brought about by 3 earning reports, namely from Meta, Microsoft, and Amazon. We also went through a short article from GPT-2 to Kimi 3 published by Base 10, a training and inference platform, which provides an in-depth explanation of the evolution of language models from GPT-2 to Kimi K3, highlighting architectural advancements and efficiency improvements. And let's briefly conclude our last night's live stream. Microsoft's latest earnings report highlights a stark contrast in performance between 2 major hyperscales, Microsoft and Meta, with their stock prices moving in opposite directions post-earnings. An 8.9% increase for Microsoft and a 7.5% decrease for Meta. Microsoft's standout results were driven by a 43% growth in Azure revenue, surpassing market expectations of 40%, and an even more optimistic 45% growth guidance for the next quarter. The company also reported an impressive $19.6 billion in free cash flow for the quarter, significantly exceeding market estimates. Key factors contributing to Microsoft's strong performance include a robust 84% growth in commercial remaining performance obligations, RPO, with nearly 90% of FY 2026 cloud revenue projected to come from non-frontier model customers, and Microsoft 365 Copilot paid seats surging from 20 million to over 30 million in a single quarter. Additionally, GitHub Copilot users reached approximately 50 million, with related revenue growing 60% quarter-over-quarter due to the introduction of usage-based billing. Microsoft's strategic shift to extend the economic lifespan of data center from 15 to 25 years also resulted in a reclassification of capital expenditures, further optimizing financial reporting. Unlike Meta, which struggled with rising costs outpacing revenue growth, Meta struggled with its rising cost of 50% increase, outpacing its revenue growth of a increase in outpacing its revenue growth with 28% increase and a 91% year-over-year decline in free cash flow to $784 million. Microsoft's AI investments appear to be yielding substantial returns across multi-layers of its business, from IaaS and PaaS to applications like Microsoft 365 and GitHub. Microsoft also distanced itself from the risks associated with frontier AI labs, emphasizing that 90% of its cloud revenue comes from non-frontier model customers, and that its $50 billion backlog growth excludes OpenAI. This strategic positioning and demonstrated ability to monetize AI investments across various verticals underscore Microsoft's resilience and leadership in the AI-driven enterprise market. And let's summarize the GPT-2 to Kimi K3 in a few words. GPT-2 uses a decoder-only architecture with token and positional embeddings, just like the original transformer models. Yeah, and the model consists of transformer blocks, each containing layer normalization, causal self-attention, and multilayer perceptrons (MLPs). The attention process is detailed, showcasing how the inefficiency of decoder-only generation was discussed in the paper, particularly the need for caching to avoid redundant computations. The KV cache invention allows the model to store key and value vectors, reducing the need for recomputation during token generation. Linear attention is introduced as an improvement over traditional softmax attention, optimizing memory usage and speeding up processing. DeltaNet implements a first-order linear recurrence for efficient training, allowing parallel processing of tokens. The architecture of gated DeltaNet GDN incorporates a mechanism for managing memory decay, enhancing the model's ability to forget or replace associations dynamically. Kimilinear, the kimilinear layer, combines multiple attention prompts to improve its memory management and decoding throughput. The latest model, Kimi K3, incorporates advanced features such as gated MLA, latent space, mixture of experts, and see-through activations. It emphasizes the importance of selective retrieval of earlier representations to improve inference speed and efficiency. And finally, ATTN RES allows layers to selectively access previous outputs, improving the model's ability to leverage historical information without overwhelming the memory. The progression from GPT-2 to Kimi K3 illustrates a significant advancement in attention mechanism, memory management, and overall model efficiency, resulting in a more powerful and scalable language processing system. Each architectural change is driven by specific functionalities, addressing limitations in previous design. The cryptocurrency market experienced a shift from high levels to a phase of consolidation last week. Bitcoin BTC briefly rebounds above 65,000 US dollars, but faced pressure due to ETF outflows and cautious sentiment ahead of the Federal Reserve meeting, subsequently retreating to around 62,000 US dollars before stabilizing near 65,000. Ethereum ETH demonstrated relative stability, climbing from approximately 1,860 to nearly 1,980. In terms of ETF flows, BTC ETFs saw a total outflow of 269 million, with the majority occurring on the 24th of July. The largest single-day outflow was around 240 million, primarily driven by divestments from IBIT and FBTC, followed by tempering of outflows and slight inflow on the 29th of July. ETH ETFs recorded outflows of 82.5 million, with notable activity on the 24th of July and 29th of July, indicating continued cautious institutional sentiment. Largely due to withdrawals from ETHA and FETH. Despite some minor inflows during the middle of the week, the latter part saw an additional outflow of about 32.9 million. This pattern suggests that the capacity to absorb funds in Ethereum ETFs is currently limited, reflecting a cooling in institutional appetite compared to earlier periods. On the macroeconomic front, the Fed maintained interest rates at 3.5% to 3.75%, though internal divisions emerged as three officials supported rate hikes. Meanwhile, US Q2 GDP grew at an annualized rate of 1.5%, down from Q1's 2.1%, but consumer spending rose by 3.2%, suggesting resilient demand. This mix of interest rate uncertainty and economic resilience limited the upward momentum for BTC and ETH. Market sentiment indicators reflect ongoing caution, with CoinGlass Fear and Greed Index at 27 Fear, and CoinMarketCap's index at 337 Fear. BTC dominance slightly declined to 59.28% from 59.36% last week. The U.S. Securities and Exchange Commission (SEC) has temporarily halted Nasdaq's conditional approval to list cash-settled Bitcoin index options under the ticker QBDC, following a legal challenge from CME Group. The SEC's initial approval in May required additional exemptions from the Commodity Futures Trading Commission (CFTC) before the product could launch. CME Group contested the decision in June, asserting that Bitcoin is classified as a commodity and therefore falls under the exclusive jurisdiction of the CFTC rather than the SEC. CME further argued that Nasdaq would need to register as a CFTC-regulated futures or swaps venue, or restructure the contracts to align with securities regulations, such as tracking a Bitcoin exchange-traded fund. The dispute raises broader regulatory implications, as CME warned that approving such derivatives on securities exchanges could set a precedent for similar products tied to other commodities. The SEC has frozen the approval while it reviews the matter, inviting public comments until the 28th of August. In the interim, QBDC will remain suspended, with the SEC emphasizing that exemptions cannot be used to shift regulatory oversight from one agency to another. Over the past half week, following the linear signals and the Federal Open Market Committee's FOMC guidance, the market direction has become increasingly clear. The gravitational pull of the trendline liquidity around the 61,000 level has begun to be cleared as expected. So there's been partial liquidity swap at around the 61,000 US dollars level, aligning perfectly with the smart money concept's predictions. However, a complete bridge between below 61,000 is necessary to consider this process fully accomplished, which has not yet been achieved. Instead, the emergence of new equal lows EQL at 62,400 further enhances the probability of another downward sweep of liquidity. Additionally, the minor upward trend structure that had been forming since the 6th of July has been disrupted, completing a 1-2-3 pattern or a change of character, which also supports Bitcoin's potential return to the grid to the demand zone for a retest, considering a technical analysis perspective. On the 29th of July, the Federal Reserve maintained its interest rate at 3.5% to 3.75% for the fifth consecutive time. However, three regional Federal Reserve Bank presidents, Hamad, Kashkari, and Logan, dissented, advocating for a 25 basis point increase. This marks the highest level of hawkish dissent since September 2016. Additionally, Walsh has revised the year-end inflation forecast upwards, and the dot plot indicates that officials anticipate a rate hike before the end of the year. Compounding these pressures, oil prices have surged over 20% in 2 consecutive weeks due to the ongoing conflict between the US and Iran, intensifying inflationary pressures. Reflecting this sentiment, the probability of a rate increase before the 9th of December meeting has risen to 66% on Polymarket. The market broadly receives the September meeting as the pivotal moment for a potential rate hike. Japanese Financial Minister Satsuki Katayama confirmed on the 3rd of August today that Japan and the United States jointly intervened in the foreign exchange market on the 31st of July Eastern Time, purchasing Japanese yen to addressing its recent volatility and disorderly movements. This action, based on the joint statement issued by the two countries' finance ministers in September last year, marks the first such collaboration since Japan's intervention following the 2011 earthquake and the first yen buying intervention since the 1998 Asian financial crisis. The Japanese Ministry of Finance emphasized its commitment to closely monitor developments and take further coordinated measures if necessary, while also leveraging the Federal Reserve's financing mechanism to secure dollar liquidity without selling U.S. Treasury holdings. U.S. Treasury Secretary Scott Bessent expressed strong support for Japan's decisive actions to correct the yen's undervaluation and urged the Bank of Japan (BOJ) to consider further interest rate hikes. President Donald Trump, speaking aboard Air Force One on the 2nd of August, stated that the intervention was a reflection of the strong U.S.-Japan relationship and highlighted economic benefits for both nations and global economic stability. Following the intervention, which included yen purchases by Japan and dollar sales by the Federal Reserve Bank of New York, the yen appreciated by over 5 yen against the dollar, reversing its recent decline. Despite early efforts in April and May, as well as June interest rate hike by the Bank of Japan to a 31-year high of 1%, the yen had remained weak until this recent joint action. Nvidia is reportedly in discussions to provide $250 billion in financing to assist OpenAI in leasing a 10 gigawatt data center project in Ohio, developed by SoftBank. This initiative, potentially exceeding $500 billion in total cost, marks the largest data center project ever announced. The power for this facility is regulated by the US government and separately funded by Japan under a recent trade agreement, with Commerce Secretary Lutnick involved in determining power allocation. OpenAI has set ambitious targets for its compute capacity, aiming for a $750 billion investment by 2030 to achieve a total of 28.75 gigawatt, which, with contributions from Nvidia and Broadcom at 10 gigawatt each and AMD at 6 gigawatt. Meanwhile, Anthropic has adopted a multi-vendor strategy with a long-term compute spending target of $180 billion for 11.7 gigawatt, partnering with AWS and Google for 5 gigawatt each and Azure for 1 gigawatt. Anthropic also plans to invest $5 billion in AMD, securing a 2 gigawatt deal to acquire AMD's latest chips valued at tens of billions of dollars. The company has further strengthened its supply chain through agreements with Samsung Electronics and SK Hynix, as confirmed by CEO Dario Amodei during the recent AI Summit in San Francisco. The recent stock market downturn, initially perceived by many as a mere correction, has quietly set numerous historical records. The market, characterized by high leverage and volatility, serves as a reminder to investors to secure profits during periods of intense market exuberance. Notably, Goldman Sachs' high beta stock basket has experienced its worst monthly performance on record, surpassing the downturns of the 2000 dot-com bubble and the 2008 financial crisis. In South Korea, stock market volatility reached an 18-year high, with the Korean version of the VIX PKOSPI closing at 96.94 and peaking at 97.99 on the 29th of June 2026, marking the highest levels since its official launch in April 2009. Additionally, Oracle's 5-year credit default swap (CDS) has surged to approximately 215 basis points, representing the highest level since data became available at the end of 2008. These developments underscore the unprecedented nature of the current market conditions and highlight the importance of strategic risk management. JP Morgan has indicated that the deleveraging process for leveraged ETFs appeared to have largely concluded, with ETF assets under management shrinking by 66% and fund inflows stagnating. Additionally, retail margin balances have decreased by approximately 15% from their peak levels. Despite these improvements, the bank cautions that residual spillover effects from the deleveraging process may still persist, making it premature to confirm a definitive market bottom. In the South Korean market, KOSPI's forward price-to-earnings ratio (PE) has reached an attractive level of around 5 times. As the financial structure of the market shows signs of stabilization. Notably, foreign investor outflows, which reached record levels in May and June, have slowed significantly by mid-July. Though recent selling activity warrants further observation to determine if it signals a renewed trend. Between the 27th of July and 29th, forced liquidations due to insufficient margin reached 97.98 billion KRW, approximately $68 million US, with the 29th of July alone accounting for a forced liquidation rate of 5%. Meanwhile, semiconductor stocks experienced significant declines, while Apple AAPL saw trading volume surge by 30.84 times over 5 days, rising from 16,371 contracts to 504,936 contracts, despite a negative 7.62% drop in its share price. Apple's trading value spiked to 165 million, suggesting heightened interest and activity in consumer electronics. This may indicate that market participants are testing positions or beginning to digest prior bearish factors, such as memory price hikes. If trading volumes continue growth or crude oil trading volumes decline, Apple could potentially regain market attention. The tokenized stock sector, while experiencing robust growth, particularly through channels such as linked security tokenized stocks, issuer-sponsored tokenized securities, and the expansions of perpetual future exchanges, is facing a notable challenge in the form of liquidity fragmentation. This fragmentation occurs both vertically across different tokenization structures and horizontally across various providers employing similar structures. While this issue poses a significant challenge, it also highlights an increase in accessibility to US stock market liquidity for investors who previously lacked such opportunities. The fragmentation, therefore, could be seen as a byproduct of this newfound accessibility rather than a mere division of existing liquidity. Addressing this challenge requires strategic solutions, such as the development of orchestration or clearing platforms akin to those in the stablecoin sector, or perhaps industry consolidation into fewer larger entities to leverage economies of scale. These approaches could potentially streamline liquidity and enhance the efficiency of the tokenized stock market. According to a report by CoinDesk, cold hard wallets recently experienced a significant security breach, resulting in an attack involving almost $100 million US. In light of the recent developments, Binance founder Zhao Changpeng has issued a public statement urging users to adopt a diversified wallet strategy, following the discovery of a significant security vulnerability in cold hardware wallets. This vulnerability has reportedly resulted in a potential loss of approximately $100 million US. Let me share the original paper reference. Actually, the bibliography typed in the chat room already. The paper Algebraic Interference from Discrete Nabla Operators to Quantum Field Divergence and Real-Time Spatial Compression introduces a formal mathematical framework that equates multivariate alternating sign discrete differential identities with quantum mechanical interference. The author establishes that n-dimensional products can be computed as the total divergence of discrete Nabla operator Nabla n, acting on a scalar potential field defined over a Boolean hypercube Hn. Sorry, I'm mistakenly turned off my microphone. The paper Algebraic Interference from discrete Nabla operators to quantum field divergence and real-time spatial compression introduces a formal mathematical framework that equates multivariate alternating sign discrete differential identities with quantum mechanical interference. The author establishes that n-dimensional products can be computed as the total divergence of a discrete Nabla operator, Nabla n, acting on a scalar potential field. Defined over a Boolean hypercube Hn. The research originates from the observation that 2D integer multiplication is a second-order discrete difference of triangular numbers. A times b equals triangle a plus b minus triangle a minus triangle b. The author generalizes this identity into an n-dimensional discrete polarization identity, termed Gauss binomial identity. Nabla n phi equals summation s subscript n negative 1 to a power n minus modulo the norm of s binomial summation I in s xi and equals to the product of xi for I from 0 to n minus 1, where phi s equals binomial summation I in s xin serves as a scalar potential evaluated at vertex s. This identity is verified using the Linford theorem prover, focusing on the product theorem. Proving divergence evaluates to the coordinate product and the operator and annihilation theorem, demonstrating that fields with polynomial degree k less than n vanish under the Nabla n operator. The paper establishes an isomorphism between this discrete field theory and Feynman's path integral. In this mapping, that's why this paper is named as isomorphism. In this mapping, the path integral ins dx corresponds to the iterated discrete Nabla operator. Nabla n equals the product of Nabla I from I1 to n. The complex phase e to the power isx over h bar corresponds to the directional derivative parity, -1 to the power n minus norm of s. Disruptive interference is identified as the physical mechanism by which lower order gradient fluctuations cancel out, leaving only the maximal state k equals n as the emergent observable. To mitigate the exponential memory overhead 2 to the power n vertices inherent in classical von Neumann architectures, the paper proposes two hardware-level solutions. The first is Pascal streaming, utilizing matrix exponentiation p equals e to the power a, where a is a nilpotent subdiagonal matrix implemented via systolic arrays. This allows the potential boundary values to be streamed on the fly, reducing static memory to order 1. That is constant. The second is spatial compression, the introduction of the new xy equals 2 to the power x minus log 2y operator. This functional primitive acts as a logarithmic compressor, mapping the exponential growth of the field space into a bounded, hardware digestible bit width, preventing register overflow during high-order differential evaluation. The paper concludes that this framework provides a deterministic algebraic approach to Boolean satisfiability (SAT) problems, and suggests that these non-monotone filters over compilation landscapes can be utilized to build hardware coprocessors capable of unbounded spatial field simulation. And let's share this algebraic inference. It might seem mysterious, but let's start with a simple question. We all learned in elementary school what is multiplication. In traditional computers, multiplication is performed by complex logic circuits. However, Dominic Strom's paper proposes a very elegant perspective where multiplication can also be viewed as a change in a field. Consider the formula. Actually, I have prepared a slide in Chinese first. You may also view this slide, but I think we don't need to use this because this time the thesis is only 5 pages, so it's quite short, and we may directly explain the paper. It initiates from this structural observation in discrete coordinate systems. The product of two scalar parameters a and b can be computed with the ta plus b minus ta minus tb, where tn equals n times n plus 1 over 2. This formulation can be formally proven via discrete algebraic expansion. ta plus b minus ta minus tb equals a plus b times a plus b plus 1 over 2 minus a times a plus 1 over 2 minus b times b plus 1 over 2 equals a squared plus 2ab plus b squared plus a plus b minus a squared plus a minus b squared plus b over 2 equals 2ab over 2 equals ab. I think you don't have any problem with this. Just a very simple elementary school or just some secondary school so let's move on to the second part. This part we may explain a little bit. So this is the mathematical framework given by which uses the Lean-4 formulation. This section establishes the formal basis for computing the product of n variables using high-dimensional discrete differences. And here's a breakdown of the key components of the framework. The formula shown in actually, can you see my share screen? If you can see the share screen, please type in the number 1 in the chat room. And this is the core formula in this paper, presented as Nabla n phi equals the summation of negative 1 to the power n minus norm of s times for s subset n times the summation of xi for I element of s to the power n. Here, Nabla n phi represents the iterated nth order discrete Nabla operator acting on the scalar potential field phi. Summation of negative 1 to the power n minus norm of s for s subset n. This term performs the alternating sign summation over all vertices s of an n-dimensional Boolean hypercube. It acts as a filter that causes disruptive interference for low-degree terms. And the term summation of xi I element of s to the power n is a binomial scalar potential evaluated at a specific vertex s. And you may find the structure similar to the original binomial theorem we all learned in secondary school. On the right-hand side, the output of the identity, product of xi for I from 0 to n minus 1, is exactly the product of the input variables. The Lean-4 formalization, the Lean-4 formal proof strategy is that to ensure there are no hidden algebraic errors, the author used Lean-4, which is a tool for formal mathematics. It's actually a Lean language. You may use it to prove theorems and also do some coding tasks. This confirms that the identity is not just a numerical coincidence, but a logically sound algebraic law. A critical part of the proof is showing that if the potential field's polynomial degree is less than n, the result of the operator is exactly 0. This is what allows the identity to isolate the desired product while ignoring all lower order noise. The proof relies on induction, splitting the n-dimensional hypercube into two n-1 dimensional subspaces. By using the discrete version of the fundamental theorem of calculus, the author shows that the summation over these subspaces leads to the rational product term, confirming the identity holds for any n. Which means that the author bridges the gap between discrete arithmetic, like multiplying numbers, and advanced physics, quantum field theory, by treating the multiplication of numbers as a field divergence problem. This paper suggests that traditional digital computation might be missing out on interference-based optimizations used by nature itself. And let me also elaborate on the lean for formal proof strategy as well. This is a rigorous verification of the algebraic framework proposed by the author using Lean4 instead of relying on manual derivation, which can be prone to errors in high-dimensional calculations. The author uses the Lean4 theorem prover, which is a language and environment where mathematical proofs are machine-checked for absolute correctness. The mutual inductive operator lemma is the core logical structure. A mutual induction suggests that the proof requires two properties. That is the product theorem and the operator annihilation theorem to be proved simultaneously. One property likely relies on the result of the other, requiring them to be verified as a single interdependent block to avoid circle argument. In formal proofs, a standard induction proving for n and showing it works for n+1 often fails if the hypothesis is too weak. So it uses a strengthened induction hypothesis. This is actually a quite common technique when you conduct mathematical induction. A strengthened hypothesis adds extra constraints or information to the assumption, making it easier to show that the property holds during the transition from n to n+1. The product theorem validates that the high-dimensional spatial divergence Nabla n acts as a multiplication engine. Mathematically, it confirms that Nabla n to the power n phi, that is the nth order discrete Nabla operator, equals to product of xi for I from 0 to n-1. That is the resulting product of the input variables, effectively performing multiplication through differential geometry rather than standard arithmetic. The operator annihilation theorem is the noise reduction mechanism. Proves that if you apply this operator to any field with a polynomial degree lower than n, the result is exactly 0. This acts as a filter ensuring that lower order fluctuations are silenced, allowing the maximal state, the actual product, to emerge cleanly. Let's dive into the induction step from n to n+1. First is substitute the Vandermonde-like difference formula. That is the a plus what b choose k minus a choose k equals to the summation of a choose j times b k choose k minus j for j from 0 to k minus 1. The left-hand side represents a discrete difference by subtracting the combinations of a taken k at a time from a plus b taken k at a time. The author captures the change of gradient product by introducing the variable b into the potential field, whereas the right-hand side is a summation expansion. It breaks the discrete difference into a series of weighted products of binomial coefficients. A choose j acts as the local scalar potential evaluation at a specific index j, whereas b choose k minus j represents the contribution of the second variable across the remaining dimensions of the hypercube. This identity is the engine behind the inductive step in the author's formal proof. When proving the operator annihilation theorem, the author uses this identity to show that when the total field dimension is n, all terms where g less than n vanish. Just like the destructive interference when you learn wave, leaving only the resonant term that calculates the product of the coordinates. The geometric splitting matters since the formulation allows the author to split a high-dimensional Boolean hypercube into two simple lower-dimensional phases. This reduction step is what makes calculating higher order products computationally feasible without exponential memory usage. By treating the difference of binomials as a derivative, the author justifies the use of the Nabla operator, Nabla-n, to define field divergence in a purely discrete algebraic setting, effectively building a bridge to quantum path integration. And when you apply the induction hypothesis, you may isolate the differential summation over index j for all field degrees j less than n. The operator annihilation theorem ensures that the higher order difference over the subface P of range of n vanishes identically, and the only non-vanishing resonant terms occurs precisely at j equals n. Here it indicates a summation over all possible subsets n of the set n. 1, 2 to the 1, 2, 3, 4 up to n. Geometrically, this represents traversing all 2 to the power n vertices of an n-dimensional Boolean hypercube. Negative 1 to the power n minus the size of s is the directional derivative parity. It acts as an alternating phase factor that determines whether a contribution is added or subtracted. This is the mechanism responsible for destructive interference, causing lower order fluctuations to cancel each other out, whereas the summation of xi I as an I in S choose j is a binomial coefficient where the upper value is a summation of variables xi belonging to the subset S. It represents the local scalar potential field value at a specific vertex of the hypercube. This equals to 0 since due to the annihilation effect. It signifies that for any divergence at any field of degree j less than n, the sum of these polarized values perfectly cancels out. In the paper's quantum analogy, this equation explains why noise or non-maximal states disappear. Only when the field degree reaches the maximal state j equals n does the expression stop equaling 0 and instead use the product of the coordinates, product of xi I from 0 to n minus 1. This identity acts as a high-pass filter. It allows a computer to ignore submaximal or lower order data configuration, focusing only on the resonant maximal state, which represents the core multiplication result the author aims to compute efficiently. To ensure the reliability of the core theory, the author focuses on the abstract mathematical truth rather than the messy realities of physical hardware. And here's the detailed breakdown of the verification scope. Algebraic correctness is mathematically proven and formalized. The paper used Lin 4 to prove that the n-dimensional discrete Nabla field identity actually works, including the product theorem and the operator annihilation theorem mentioned above. The formal verification covers the logic behind the streaming partitions. This ensures that the way the hypercube is split into two halves, part 0 and part 1, is logically sound for induction. The big O of D-linear error bounds for the logarithmic number system, LNS reduction tree, are proven within an abstract framework. Those that are not formally verified and require architectural explorations are the physical realization, that is, the actual hardware circuits, RTL synthesis, have not been mechanically verified, and also for functional primitives. The new XY operator, which is proposed for real-time spatial compression, remains a conceptual design rather than a verified logic gate level implementation. Consider memory or overflow constraints. While the math works in the infinite domain, integers z and real numbers r, the paper acknowledges that this hasn't yet proven the behavior when limited to physical finite-sized memory like a 32-bit or 44-bit bit fact. The implementation of the Pascal matrix via systolic arrays is presented as a forward-looking design, meaning it is currently a theoretical blueprint only. And let's review the isomorphism between discrete Nabla fields and quantum wave divergence. The author proposed that the God's binomial identity is not merely an algebraic curiosity, but represents the exact discrete field theoretic counterpart to Feynman's path integral formulation in quantum mechanics. This table presents a foundational bridge between the continuous mathematics of quantum field theory (QFT) and the discrete algebraic framework proposed by the author. It establishes that discrete multidimensional differences are not just calculation tools, but physical analogs to quantum interference. Here's another breakdown of the mappings. For global summation versus hypercube divergence, the continuous path integral integrate d of x sums over all possible continuous trajectories, while the discrete operator Nabla n equals product of Nabla I from 1 to n iterates the discrete Nabla operator across an n-dimensional Boolean hypercube. The paper equates this total divergence to the path integral, representing a global sum over the discrete configuration space of the hypercube. The second one is the phase rotation versus orientation vector. The complex phase, continuous complex phase e to the power isx over h bar provides the weight for each path, leading to interference patterns. The parity factor (-1 to the power n minus norm of s) serves as the discrete analog to the complex phase. This term determines the sign of the contribution at each vertex of the hypercube. Depending on the parity of the vertex, the value either adds to or subtracts from the total, creating constructive or destructive interference. H stroke is usually used in quantum physics. The parity factor (-1 to the power n minus norm of s) serves as the discrete analog to the complex phase. It determines the sign of the contribution at each vertex of the hypercube. The action functional Sx is a continuous physical trajectory weight, as it takes the weight of probability amplitude associated with a specific path, whereas the discrete scalar potential phi of s, which equals to summation of xi I in s choose and assess the potential energy as a specific vertex s. It determines the magnitude of the contribution based on the local coordinate configuration. The result of the path integral is the observable transition amplitude. When the Nabla operator acts on the potential field, the result is Nabla n phi equals product of xi I from 0 to n-1. This is the resonant emergent state when the field degree measures the operator dimension. The destructive interference of sub-maximal terms clears away the noise, leaving behind exactly the product of the input variables, a result the author views as the physical reality of the computation. Here the directional parity. The role of the directional parity is that the term -1 n minus norm of S serves as the discrete phase of the field. In quantum mechanics, complex phases like e to the power is over h stroke determine whether paths add up or cancel out. Here, the alternating signs, positive or negative, ensure that when we sum the potential field phi across the vertices of the Boolean hypercube Hn, the contributions from different vertices interfere with one another. And here's the destructive interference, the noise filter. The paper proves that if a potential field phi has a polynomial degree k less than the dimension n of the operator, the sum results in 0. Mathematically, the operator Nabla n acts as a filter that annihilates submaximal states, since the hypercube structure forces these lower degree components to have both positive and negative counterparts. They symmetrically cancel each other out. This mimics how non-physical paths in a Feynman path integral interferes destructively, leaving no trace in the final measurement. Whereas in constructive interference, the signal extraction, when the potential field of the maximal degree is of the maximal degree k equals n exactly, the cancellation does not complete. Instead, the geometric alignment creates a resonance. The lower order fluctuations are still annihilated, but the term representing the product of the coordinates, product of xi, survives. This is the observable physical reality, the result of the calculation emerging from the interference of the background fields. The author notes that this is the underlying logic of systems like the Zhou photonic computer. 九張光學電腦 While a classical machine tries to calculate a result by brute force counting of every vertex with 2 to the power n complexity, a physical system for the proposed Nabla operator lets the wave of the field naturally settle into the correct answer by letting the interference do the work of cancellation. This framework is bold because it suggests that computational complexity like T-hard problems can be mapped to physical laws. By treating logic operations as fields subject to interference, one could theoretically design hardware that senses the solution to a problem by suppressing all incorrect configurations through destructive interference. And let's move on to the architectural solutions for the memory barrier. The section for architectural solutions for memory barrier addresses the physical limitations of executing the author's mathematical framework on standard classical computers. Consider the scaling problem. The author's method requires evaluating an n-order discrete Nabla operator over a Boolean hypercube containing 2 to the power n vertices. As the dimension n increases, the number of vertices grow exponentially, 2 to the power n. Storing these potential field coefficients for these vertices in a traditional lookup table creates a memory bottleneck that makes the computation impractical for higher dimensions. standard hardware architecture for normal architecture, there is the usual classical computer we use, separates memory from the CPU. Fetching data for 2 to the power n vertices repeatedly results in massive latency and bandwidth requirements. The author aims to move away from this static storage towards dynamic on-the-fly calculation. The first strategy is Pascal streaming, matrix exponentiation. Instead of storing the values of Pascal's triangle, the author proposes generating them dynamically using the relation P equals e to the power a equals summation of a to the power k over k factorial for k from 0 to n, where aij equals I if I equals j plus 1 and 0 otherwise. Here, A is a sparse nilpotent matrix. In hardware, it is implemented as a systolic array or pipeline. By passing data through a series of simple shift registers and multiply accumulate MAC units, the system produces the necessary boundary values in real time as a temporal strip. This reduces memory usage from order 2 to the power n to order 1 static storage. The second strategy is the new XY operator. To handle the potential for numeric overflow when calculating high-order differences, the author introduces a compression primitive, new xy equals 2 to the power x minus log base 2y. This operator acts as a balance control. It essentially follows the exponential growth of the coordinate space 2 to the power x against the logarithmic reduction of the differential layer, negative log y base 2, ensuring that the values remain within the bit width constraints of the hardware registers. Let's conclude this this short paper. The final session synthesizes the paper's core achievements, transforming a simple 2D discrete arithmetic trick into a robust, high-dimensional field theory. By bridging the gap between discrete mathematics and quantum mechanics, the author proposes a novel way to handle complex computational tasks using hardware-efficient principles. And here are the key takeaways we may gain from this conclusion. The paper successfully integrates discrete algebra, quantum field theory, specifically the path integral analogy, and microarchitectural hardware design. It moves from basic triangular number differences to an n-dimensional Nabla field theory. The algebraic framework is not just theoretical, but proven by the foundational identities from product theory and the operator annihilation theorem, product theorem and operator annihilation theorem. And they have been formally verified using the Lin4 theorem prover. This provides a high degree of mathematical certainty regarding the core logic. Bridging fixed and floating point, a significant technical claim is the establishment of a link between logarithmic number system (LNS) analysis and IEEE 754 floating point standards. The author suggests that the new XY operator and the derived monotone error bound allow fixed point hardware to achieve the performance and precision profile typically reserved for floating point units. The primary contribution to hardware engineering is the proposal to replace massive static lookup tables with dynamic streaming systolic arrays. By using Pascal matrix exponentiation and the new XY compressor, the author aims to solve the von Neumann bottleneck that normally limits computations on high-dimensional Boolean hypercubes, thus overcoming the memory barrier. The author hints at a path toward applying these alternating sign Nabla phase to Boolean satisfiability SAT problems. The goal is to create specialized coprocessors that can treat compilation or logic landscapes as physical fields, potentially solving non-monotone problems more efficiently than traditional algorithmic approaches. So should you have any questions regarding this thesis, feel free to chat with us in the Discord server, and Weebearn may also transfer your question to the original author if you have any private question that you want to ask privately with the original author of this paper. Oh, actually, let me share our Discord link again. This is our international ACG community. Let's move on to the DUV achieved by China. In July 2026, a report from the Information Sent proposed through the semiconductor industry. A Chinese research team announced the successful development of their own immersion DUV lithography machines, with plans to deliver 5 units this year and 20 next year to SMIC and Hua Hong. Let me find the paper again, see if I can share with you also. No, it's not a. This time it's not a paper. It's just a report. Nevertheless, and maybe you can view the news from this side. I think it is still a secondary source, but I think it's okay for you to get a sense of what the recent market dynamic is talking about. This announcement immediately sparked a debate within the industry. One camp hailed this as a breakthrough, suggesting that China was poised to challenge ASML's dominance. The other camp dismissed it, pointing out that ASML produces 130 machines annually, questioning the significance of China's 5 machines. To truly grasp the weight of this news, one must look beyond the numbers, understanding the intricacies of lithography technology, the challenges of immersion lithography, and the gap between EUV extreme ultraviolet and DUV technologies is crucial. That is, instead of pure quantitative analysis, when we conduct our equity research or fundamental analysis, we may also consider quantitative analysis. And the quantitative analysis is where we human being or natural human being come into retain our own intrinsic value. This Starting from the basics of lithography technology and moving through the complexities of geopolitical influences and market valuation, we are going to let you understand. We're going to go through ASML and its position in the semiconductor industry. And in our opinion, our team thinks that ASML and its position in the semiconductor industry will be far more nuanced than that of most market analysts. Let's start with the essence of photolithography in chip manufacturing. Modern semiconductor chips are often hailed as miracles of human technology, yet their origins are surprisingly humble. The primary material for these chips is silicon, the main component of SAM. The essence of semiconductor manufacturing involves transforming a flat, non-conductive silicon wafer into a complex three-dimensional labyrinth containing billions of microscopic switches through hundreds of intricate processes. Among these processes, one step stands out as the determinant of a chip's performance and viability: photolithography, commonly referred to as circuit patterning. The interior of a chip resembles an exceedingly complex miniature city. This city houses billions of tiny switches, known as transistors, connected by ultra-thin wires. These transistors function as simple on or off switches, akin to light switches in a home, processing all computer signals through on, 1, and off 0 states. When billions of these switches toggle at billions of times per second, your smartphones or computer can seamlessly stream videos and run games. The challenge arises: how do we etch a city with billions of components onto a silicon wafer the size of a fingernail? No physical tool, such as a blade or drill, can achieve the atomic level precision required for carving out nanometer scale lines. In the absence of a tangible tool, scientists have harnessed an intangible, space-free, and very resistant tool, light. However, light alone cannot directly engrave marks on the hard silicon wafer. To enable light to act as an engraving tool, a special chemical solution known as photoresist is required. This entire process mirrors the traditional method of developing photographs in a darkroom. How do photolithographers draw? Here are the 3 key steps. The process of drawing the design involves preparing the canvas, where engineers evenly coat the flat surface of the silicon wafer within a thin layer of photoresist. This layer is highly sensitive to light, much like the photosensitive coating on old camera films. Enter the photolithography machine akin to a super projector. It projects strong light through a mask bearing the circuit design, similar to a patterned black and white sign, and precisely cast this pattern onto the photoresist coated wafer. The areas exposed to light soften and become easier to dissolve, while unexposed areas may remain hard. Engineers then clean the wafer with a special chemical solution. This step resembles developing a photograph. The light softened photoresist is washed away, revealing the underlying silicon surface, while unexposed photoresist remains as a protective layer. Finally, acidic gases or liquids are used to etch the wafer. Areas without protection are carved into deep grooves, while protected areas remain intact. Once the remaining protective resist is removed, a perfectly etched microcircuit pathway emerges on the wafer. In this process, the photolithography machine plays a crucial role by utilizing the physical properties of light to precisely define areas to be etched or preserved on the photoresist. Chip manufacturing involves numerous steps such as material deposition and etching groups. While important, these steps share a common trait: they are blind. Just like the material deposition machine only covers the entire surface with cement, or the chemical solution only dissolves uncovered areas naturally. These machines lack a navigation system. They do not know where to preserve or where to etch. Only photolithography can delineate construction boundaries. Photolithography serves as the chief designer and server on the production line. If it misaligns or inaccurately draws construction lines, subsequent material deposition and etching steps will occur in incorrect locations, resulting in an unuseful chip. This explains why photolithography is considered the most challenging step, facing two major limitations. The first is the challenge of fineness. Modern chip line widths are only a few nanometers wide, akin to slicing a human hair into thousands of parts. At this scale, even slight vibrations on the factory floor, a 0.1 degree temperature rise, or a single dust particle can distort drawn lines. The second is the challenge of alignment, building layers. Chips are not flat. They consist of multiple circuit layers stacked like a building. Each layer's pattern must perfectly align with the previous one. In semiconductor circuits, Moore's law is well known. The number of transistors on a chip must double periodically. Smaller transistors mean shorter distances for electric current to travel, resulting in faster and more energy-efficient chips. To achieve smaller transistors, circuit patterns must be drawn with greater precision. The primary bottleneck limiting advancement in the semiconductor industry is the pen. Photolithography machine will hold. How fine its tip can be. If photolithography technology does not advance, preventing finer strokes, then no matter how intricate chip designers' blueprints may be, chip performance cannot advance further. This is why photolithography is universally recognized as the core essence of chip manufacturing processes. In the current landscape of advanced chip manufacturing, the name ASML has become synonymous with lithographic technology. However, during the early stages of lithography development, this Dutch company struggled to even secure a place in the competitive arena. This narrative is one of technological choices, industrial alliances, and the boundaries set by physical limitations. Uh, Let us take a break of about 5 to 10 minutes. Sorry, I just received a phone call from one of my general partners. So let's continue with analysis on China's DUV. In the nascent phase of the semiconductor industry during the 1960s and 1970s, lithography machines were far less mysterious and complex than one might imagine today. At that time, chip line widths ranged from a few micrometers to over 10 micrometers, dimensions that are considered enormous by today's standards. Approximately 1/10 the diameter of a human hair. Due to the relatively lenient size requirements, early lithography machines were structurally simple, essentially resembling sophisticated cameras mounted on a frame. The manufacturing threshold for these machines was not high, allowing many American precision instrument companies to produce them. Chip manufacturers often modified their own equipment. They would draw circuit designs on large transparent plastic sheets and use ordinary strong light bulbs to project these designs onto silicon wafers coated with photoresist through a simple set of magnifying lenses. During this period, lithography machines functioned more like industrial consumables. As long as they could project patterns and align them accurately, they could produce acceptable chips. However, with the rise of personal computers, the demand for increased chip processing speed grew exponentially. Lithography machines, once as simple as cameras, faced an unprecedented optical revolution. This revolution propelled lithography machines from ordinary industry equipment to the pinnacle of human precision manufacturing technology. To understand lithography machines, it is helpful to conceptualize their operation as an inverted camera. While cameras capture large scenes and condense them onto small sensors of film, lithography machines do the opposite. Engineers create enormous, densely packed chip circuit designs akin to a living room floor plan. These designs are then reduced by millions of times using an extremely precise lens system and projected onto silicon wafers no larger than a fingernail. Given that both cameras and lithography machines involve manipulating light and lenses, the global lithography market in the 1980s was dominated by camera giants such as Japan's Nikon and Canon. In photography, minor lens imperfections might result in slightly blurred edges in photos. However, in lithography, light must pass through dozens of lenses as large as truck tires, yet smoother than a baby's skin. Any nanometer scale imperfection on these lenses can cause light deviation, resulting in deformed or broken circuits and rendering entire chips defective. Nikon and Canon leveraged their decades-long expertise in crafting top-tier camera lenses to surpass their American competitors. As transistors became increasingly compact on chips, engineers encountered a significant challenge. The drawing tool was too coarse. This is analogous to writing an entire scripture on a grain of rice with a thick marker. The ink would blur into an indistinguishable mess. In lithography machines, this drawing tool is light, and its fineness depends on the wavelength. Light behaves as a wave. When attempting to draw a line thinner than the wavelength of light, diffraction occurs, similar to how ocean waves spread out after passing through a narrow breakwater gap. If light spreads out, the resulting circuit becomes blurry and fused, leading to chip short circuits. The solution was to find a finer tool, light with a shorter wavelength. In early stages, engineers used visible blue or green light, with wavelengths approximately 400 to 500 nanometers. And in mid-stages, as chip line widths shrank below 1 micrometer, visible light proved insufficiently fine. Engineers crossed the visible spectrum threshold to employ more energetic, short wavelength, deep ultraviolet DUV light. Wavelengths reduced to 248 nanometers and even 193 nanometers. However, adopting new light sources was not straightforward. DUV's high energy levels caused ordinary camera glass lens to yellow and cloud after prolonged exposure, akin to sun damage. To extend this powerful drawing tool, scientists abandoned conventional glass in favor of extremely expensive lenses, crafted from highly pure artificial quartz or calcium fluoride crystals. Each transition in light source represented an extreme challenge in material science. By the late 20th century, the capabilities of 193 nanometer light sources had reached their limits. Industry leaders unanimously agreed that developing lithography machines with even shorter wavelengths of 157 nanometers was imperative. However, 157 nanometer light was so aggressive that it was absorbed by almost all materials, including atmospheric oxygen. This necessitated creating an absolute vacuum within the lithography machine and posed significant challenges in finding lens materials that could withstand such light exposure. Consequently, research progress stalled. Amidst global semiconductor giant struggles, TSMC's research manager, Lin Benjamin, proposed a groundbreaking idea in 2002. Why not try pouring a little water between the lens and silicon wafer? Consider how inserting chopsticks into a glass of water creates an illusion of bending due to water's high refractive index compared to air. Lin suggested that using existing 193 nanometer light sources could achieve equivalent wavelength shortening to 134 nanometers by introducing a thin layer of water beneath the lens, surpassing the elusive 157 nanometer target. At that time, this proposal seemed highly unconventional. Introducing water into a highly precise and electrically active lithography machine was seen as risky by many engineers. Water droplet vibrations, microbubbles in water, or water-induced lens contamination could potentially render the entire machine unusable. Nikon, the market leader at that time, assessed this approach as overly risky and chose to continue focusing on the 157 nanometer technology path. Conversely, ASML, a relatively minor player then, recognized that following Japanese giants would confine them to a supporting role forever. Therefore, ASML decided to stake its future on Lin's immersion lithography concept in collaboration with TSMC. Remarkably, within just 1 year, in 2003, ASML successfully launched the world's first immersion lithography prototype machine. This achievement validated Lin's water refraction strategy's feasibility and effectively rendered Nikon's 157 nanometer development path obsolete due to its high cost effectiveness. This strategic move marked ASML's first technological triumph over Japanese giants and significantly increased its market share. In the wake of the immense success of immersion lithography, ASML has successfully outpaced Japanese giants, establishing itself as the new leader in the global lithography machine market. However, the competition in the realm of sharpening the pencil tip in physics did not conclude there. As chip manufacturing process approached single-digit nanometer scales, ASML quickly realized that even at 193 nanometer deep ultraviolet DUV light immersed in water had been pushed to its physical limits. To continue advancing Moore's law, the semiconductor industry had to make the next leap, abandoning the exhausted path of deep ultraviolet light and transitioning to an entirely new light source, extreme ultraviolet. This marked a technological gamble spanning over two decades, costing billions of dollars and challenging the very limits of human engineering. Why is DUV insufficient? That is the agony and cost of multiple patterning. When chip line widths shrink to 10 nanometers or even below 7 nanometers, the immersion lithography machine with an effective wavelength of 134 nanometers becomes too coarse. It's akin to using a broad marker to draw intricate details on a small postage stamp again. The lines blur into one another. And again, to overcome this limitation, engineers devised a laborious promise: multiple patterning. Since the pencil tip is too thick to draw dense lines in one go, engineers break down the design into several layers. Use the lithography machine to draw the first set of lines, leaving wider gaps in between. In the second step, slightly shift the wafer by a few nanometers and draw the second set of lines, filling in the previous gaps. Then in the third step, through 3 or even 4 rounds of repeated exposure and chemical etching, extremely dense circuits are finally pieced together on the wafer. Although this method extended the lifespan of DUV lithography machines, it came at an extremely high cost. Each exposure requires intricate cleaning, coating, alignment, and etching process. This not only exponentially increases the production cycle of chips, but also poses a critical risk. Any misalignment by a few nanometers during any drawing phase could render an entire wafer useless. As processes become increasingly advanced, the yield of multiple patterning drastically declines, and production costs rise exponentially. The semiconductor industry realized that multiple patterning had reached a dead end. To continue making chips much smaller and cheaper, the only way forward was to seek a completely new light source with a wavelength of just 13.5 nanometers, extreme ultraviolet (DUV), capturing light non-existent on Earth. That is the 3 major physical challenges of DUV. Filming directly from DUV's 193 nanometers to UV's 13.5 nanometers is a significant leap in physics. However, applying this light source in actual production poses 3 physical challenges for scientists. The first challenge comes with producing the light source, shooting mosquitoes in the storm. Extreme ultraviolet light cannot naturally exist on Earth. This high-energy light is extremely close to X-rays and typically exists only within stars. To address this issue, ASML developed an extremely complex system. They heat liquid tin to melting point and let tin droplets, only a third the diameter of a human hair, fall at a speed of 50,000 drops per second. As the tin droplets fall, a high-power laser fires 2 consecutive shots. The first shot flattens the spherical tin droplet, and the second shot hits the deformed droplet within a millionth of a second, instantly heating it to hundreds of thousands of degrees, converting it into high-temperature plasma and releasing 13.5 nanometer UV. This process repeats 50,000 times per second, akin to shooting mosquitoes flying at high speed kilometers away with arrows in the storm, and hitting every time. The second challenge is the vacuum environment, where everything is an obstacle. Extreme ultraviolet light is absorbed by almost every material. It vanishes upon contact with anything. Previously, light could pass through air and glass lenses. However, since air absorbs UV, the entire lithography machine weighing 180 tons must be evacuated to an ultra-clean vacuum environment surpassing outer space. Moreover, no glass lens on Earth can allow UV to pass through. Light is completely absorbed upon contact with glass. The third challenge comes with the limits of mirror. Since lenses cannot be used for refraction, scientists resorted to mirrors for reflecting light. German optical giant Zeiss developed ultra-thin nano-reflective mirrors that utilize optical interference principles to barely increase UV reflectivity to 70%. This means that approximately 30% of energy is lost each time light reflects off a mirror. After passing through thousands of mirrors within the lithography machine, less than 2% of energy reaches the wafer. Additionally, these reflective mirrors demand flatness, reaching human manufacturing limits. If expanded to cover all of Germany, the maximum unevenness of the mirror surface should not exceed the thickness of a cone. With such high prices and strategic value for lithography machines, why can't other tech giants or power nations develop their own equipment from scratch to compete? The answer lies in 2 insurmountable supermodes: monopoly on global top supply chains. That said, supply chain management is money management. One who masters supply chain management also masters a significant division of money management. An advanced lithography machine comprises over 100,000 components sourced from thousands of top global suppliers. Size lenses from Germany, laser sources from Cymer in the US, precision bearings from Sweden, special materials from Japan. This collaborative relationship is exclusive. New players must surpass these century-old companies across dozens of foundational scientific fields simultaneously. And this also shows the beauty of division of labor in capitalism. There's an extremely skewed market return ratio. Globally capable customers for purchasing advanced lithography machines were historically limited to TSMC, Samsung, and Intel, these three companies. Developing a new generation lithography machine requires investments of billions of dollars. Without securing orders from these three giants, massive investments would directly go down the drain. So why did only ASML win the EUV endgame? Facing the ultimate challenge of EUV, Japanese companies chose relatively conservative routes. Nikon deemed technical risk too high and decided to continue optimizing DUV. Canon turned towards developing alternative technologies like nano imprinting. Unlike their cautious Japanese counterparts, ASML opted for an all-in strategy and adopted a unique interest bundling strategy. Bundling top suppliers, acquiring stakes in Zeiss Germany to ensure exclusive supply of top lenses, acquiring US laser source manufacturer Cymer in 2013 to incorporate core laser generation technology under its umbrella. This is another successful example demonstrating why supply chain management is critical and essential for money management. Bundling core customers in 2012 when UV development was at its toughest and funds were nearly exhausted. ASML launched a joint investment plan inviting Intel, TSMC, and Samsung as co-investors to secure priority purchase rights for future advanced equipment. These three competitors unprecedentedly injected billions into ASML's R&D fund. This unique industrial ecosystem provided ASML with continuous funding and access to global top engineering expertise. When DUV's physical potential was finally exhausted, forcing semiconductor industry towards inevitable EUV era transition, people were surprised to find only ASML prepared adequately. Nikon and Canon faced insurmountable technical gaps due to early strategic abandonment in UV field development. This gigantic machine weighing hundreds of tons, comprising over 100,000 components, ultimately propelled ASML onto global technological power pinnacle. As ASML stands as the pinnacle of global technological power, monopolizing the supreme throne of extreme ultraviolet lithography (UV. The global semiconductor industry is experiencing a significant upheaval. In this highly collaborative and precise industry, a major player with a vast market and ambitious aspirations is undergoing a dramatic transition from a frenzied buyer to being forced to self-reliance. This player is China. Before the technological Iron Curtain fully descended, China was the most prominent super buyer in the global semiconductor equipment market. As China vigorously developed its domestic chip manufacturing industry, local wafer fabs exhibited an almost insatiable demand for lithography machines. At that time, not yet subjected to comprehensive restrictions, Chinese companies wielded substantial financial resources to make massive acquisitions in the global market. China even became one of ASML's most crucial revenue pillars. Apart from the most advanced equipment, Chinese enterprises really acquired all types of deep ultraviolet DUV lithography machines ASML could offer. According to statistics, by the end of 2023, ASML had assembled approximately 1,400 DUV and metrology units in China. At its peak, Chinese buyers consumed more than 70% of ASML's global shipments of immersion DUV lithography machines. This aggressive purchasing strategy enabled China to establish a vast chip production capacity in a remarkably short period, layering a solid hardware foundation for subsequent technological transitions. However, this prosperity, heavily reliant on external supply, conceals significant security concerns. With shifts in geopolitical winds, this seemingly smooth procurement pathway was abruptly severed. In conclusion, China's journey from an eager acquirer to a nation compelled towards self-sufficiency highlights the intricate balance between global cooperation and national security. As geopolitical dynamics evolve, China's strategic decisions in the semiconductor domain will undoubtedly play a crucial role in shaping the future landscape of global technology。我用白話講一講就係、最開頭中國其實係 ASML 嘅最大買家，係買咗好多光刻機。咁呢個就體現咗呢個資本主義分工嘅成功。咁但係最終中國因為禁運等等原因啦，咁我逼住要自主研發，咁我先至開始最近講話搞翻呢個 DUV。In recent years, the field of artificial intelligence had witnessed a resurgence of interest in ontologies, a concept that dates back to the early days of computer science and even further to the philosophical inquiries of Aristotle. This revival is being driven by the need for more structured and logical frameworks within AI systems, particularly as they become more complex and agentic. At the forefront of this movement is Frank Coyle, a computer science professor at UC Berkeley, who has been instrumental in reintroducing ontologies to today's AI engineers. Cole's presentation at the AI Engineer World's Fair AIEWF highlighted the importance of ontologies as logical guardrails for agentic systems. While large language models (LLMs) excel in probabilistic reasoning, they often lack the structured guidance that ontologies can provide. In computer science terms, an ontology is a structured representation of data, encompassing classes, properties, and relationships within a specific domain. Cole succinctly describes ontologies as data as graphs, underscoring their foundational role in AI's evolution. The renewed interest in ontologies is not limited to academia. Neo4j, a leading company known for its graph database system, is actively incorporating ontologies into its agentic products. During his keynote at AIEWF, Neo4j CEO Emil Eifram outlined 3 types of ontologies crucial for enabling a smarter shared substrate, necessary for running agents at scale: business-facing ontologies, technical ontologies, and execution traces. These layers contribute to a semantic framework that enhances the functionality and scalability of AI systems. This resurgence is not merely a theoretical exercise, but has practical implications for AI development. Established web ontologies such as schema.org, FOAF, and Dublin Core are being leveraged to build more robust agentic systems. These ontologies are already part of the training data for many LLMs, allowing developers to utilize them without reinventing the wheel. As Cole pointed out, these existing frameworks are integral to the foundation of many current technologies. The convergence of probabilistic agents with ontologies has been termed neurosymbolic AI by Coyle. This approach combines neural networks with symbolic AI, including rule-based systems and knowledge graphs. Such integration provides a mechanism to keep LLMs within their guardrails, ensuring more reliable and accurate outputs. However, the adoption of ontologies is not without challenges. Maintenance and updating have historically been significant hurdles, contributing to the limited success of the semantic web vision in the late 1990s and early 2000s. Current AI developers like Prasenjit Sarkar suggest that integrating ontology maintenance into an agent's operations could mitigate these issues. Although it remains a complex problem, the structural nature of ontologies align well with the sometimes unpredictable nature of probabilistic LLMs. They offer a means to harness the power of LLMs while providing a system of checks and balances. As Ephraim explained, ontologies enable a transition from thick agents with manually wired data sources to thin agents on a smarter shared ontology-based semantic layer. Close insights extend to loop engineering, a long-standing concept in computer science where loops can be potentially malfunction or deviate from expected behavior. Ontology system can serve as guardrails for these loops, providing a bounded set of rules around an unbounded loop. Tools like OWL Web Ontology Language offer axioms that machines can enforce, ensuring that agentic system remains on track. The renewed focus on ontologies reflects a broader trend in AI engineering towards quality control and the integration of human oversight. The 2025 trend of vibe coding suggested an era where anyone could create software effortlessly. However, as the industry matures, there is a growing recognition of the need for disciplined software engineering practices to ensure reliability and maintainability. As we move forward in 2026, the retrieval of web ontologies signifies a return to a foundational principle in AI development. By incorporating these structural frameworks, AI engineers are better equipped to manage the complexities of modern AI systems, ensuring they operate within defined parameters and deliver consistent results. Now let's move on to the money management regarding electricity pricing in the age of AI. I think most of us have been using electricity to mine Bitcoin or train AI. And let me paste the bibliography in the chat room again, such that you may read this paper with us together. The rapid expansion of artificial intelligence technologies has led to an unprecedented demand for data centers, which are the backbone of AI infrastructure. However, the growth of these facilities is increasingly constrained not by hardware availability, but by power supply limitations. 呢個就係有一啲大陸人話咩長期缺儲存幾時都缺電啊there's a saying in Chinese that memory storage and electricity power supply is always in shortage. They are always scarce. Or in other words, the scarcity of electricity power supply, electricity energy supply continues in the coming years. As data centers already consume approximately 5% of the United States power, and with their power demand doubling every 2 years, it is imperative to explore the dynamics at play in this sector. This article aims to provide a comprehensive understanding of the intersection between power generation and data center development, offering insights for founders, investors, and traders like us interested in energy markets. The development of data centers involves a complex interplay of factors, including site selection, infrastructure planning, and power procurement. The viability of a data center is often contingent upon the cost and availability of power, necessitating strategic planning and negotiation. Power plants, the primary sources of electricity, operate on various fuels such as various fossil fuels such as coal, natural gas. Besides fossil fuels, you may also use nuclear energy and some renewables. Each type of power plant has its own operational characteristics and cost structures, influencing the overall pricing of electricity. Understanding these intricacies is crucial for founders and investors aiming to optimize data center operations. Recently there's a coming data center powered by nuclear energy. When developing a data center, it is essential to consider the permitting processes, local infrastructure capabilities, and anticipated power prices. The location of a data center can significantly impact its operational cost and efficiency. Close proximity to power plants or renewable energy sources can offer economic advantages. For traders, understanding how to price US power markets is vital. The power market is influenced by multiple factors including fuel prices or oil prices, weather conditions, regulatory challenges, and technological advancements. Traders must be adept at analyzing these variables to make informed decisions. Pricing in the US power markets involves both spot and future markets, or even some small options market. Spot markets deal with immediate electricity delivery, while futures market involve contracts for future delivery. Traders must understand market trends and leverage financial instruments to hedge against price volatility. Additionally, regulatory policies play a significant role in shaping the power market landscape. Policies promoting renewable energy adoption can impact supply dynamics and pricing structures. Traders need to stay informed about policy developments to anticipate market shifts. In conclusion, the expansion of AI technologies and data center presents significant opportunities and challenges in the energy sector. Founders and investors like must navigate the navigate the complexities of power procurement and site selection to ensure successful data center operations. Simultaneously, traders must also develop a nuanced understanding of market dynamics to effectively price electricity. As the demand for AI continues to grow, so too will the need for strategic approaches to power management in data center development. This primer serves as a foundational guide for those seeking to capitalize on opportunities within this evolving landscape. In the intricate world of commodities, pricing mechanisms are governed by delicate balance of supply, demand, net exports, and storage changes. This dwells into the fundamental principles of commodities pricing, providing insights into how these markets operate, particularly focusing on the unique aspects of power markets. Commodities are broadly categorized into three primary groups: energy, including power, crude oil, and natural gas; agriculture, and metals. These asset classes share certain intrinsic properties that distinguish them from equities and other financial instruments. There are two pivotal distinctions between equities and commodities. The first is the forcing function of pricing. Unlike stocks, which lack a mechanism to tether prices to intrinsic values, commodities are bound by contracts with fixed settlement dates. This ensures that prices align with reality, as physical transactions occur upon settlement. The second is the interconnectedness. Equities represent commodities entangled in complex relationships, whereas commodities interact in a straightforward manner. For instance, crude oil can be easily transported globally, influencing domestic prices, while natural gas is more challenging to export, affecting local markets differently. The commodities market operates under a system balance equation. Supply equals demand plus net exports plus change in storage. This equation must hold true universally, with constraints such as transportation limits and storage capacity influencing market dynamics. Price adjustments are critical in balancing the system. An increase in price at a location prompts higher production, reduced demand, decreased net exports, and incentivizes storage releases. The market price ultimately reflects the marginal cost of the cheapest producer capable of meeting additional demand. In competitive markets, all units are sold at a uniform price, determined by the marginal cost of production. This principle ensures that producers cannot arbitrarily set prices above marginal cost without being undercut by competitors. Power markets differ significantly from other commodities due to their reliance on physical infrastructure and the role of independent system operators (ISOs). These entities manage grid stability by balancing supply and demand across numerous interconnected businesses through transmission lines. And here comes another equation, that is the electricity distinct equation. In power markets, the equation adapts to generation equals power consumption plus net power exports plus change in storage plus losses. This reflects the complexities of electricity generation, consumption, transmission losses, and storage capabilities. ISOs play a crucial role in maintaining grid stability by coordinating bids from utilities and offers from power plants. They ensure efficient market pricing and manage generation based on anticipated consumption patterns. In regions without ISOs, balancing authorities assume this responsibility to prevent grid imbalances. Understanding the fundamentals of commodities pricing is essential for navigating these markets effectively. From the interconnectedness of global crude oil markets to the intricacies of power grid management, each commodity presents unique challenges and opportunities. By grasping these principles, stakeholders can better anticipate market movements and make informed decisions in this dynamic landscape. The generation of electricity is a cornerstone of modern society, and power plants play a pivotal role in meeting the ever-growing demand of energy, from natural gas and coal to renewable energy sources like wind and solar. Power plants are the backbone of the energy grid. In this article, the author explored the energy engineering principles, cost structures, and economics that drive power plants' operations, with a particular focus on natural gas generators. Electricity prices are largely determined by the marginal cost of producing power. This cost is set by the marginal unit, the generator that produces the last megawatt hour, MWH, required to meet demand. In many cases, natural gas or coal generators are the marginal units that set the local market price. This pricing mechanism employed in most energy markets is known as a uniform clearing price auction. Under this system, all generators that supply electricity during a given period are paid the same price, which is determined by the marginal cost of the last unit dispatched. This ensures that power plants are incentivized to operate as efficiently as possible, minimizing costs while maximizing output. To understand power plants in greater detail, one can refer to the EIA 860, an annual report compiled by the U.S. Energy Information Administration, EIA. This comprehensive document lists nearly every power plant on the U.S. grid with a capacity greater than 1 million watt. The report provides essential details about each plant, including its capacity measured in megawatts or gigawatts, fuel types, and efficiency metrics. Power plants can be categorized based on their fuel sources. Solar and wind plants are increasingly common due to their minimal environmental impact and declining costs. Hydropower uses water flow to generate electricity, and nuclear power relies on nuclear reactions to produce steam for turbines. Fossil fuels include natural gas, coal, and oil or diesel generators. The marginal cost of electricity production typically follows an ascending order based on fuel type, starting with renewables with the lowest cost and ending with oil or diesel with the highest cost. However, specific factors like efficiency can shift this order, particularly for natural gas and coal generators. Natural gas generators are among the most commonly used power generation units due to their flexibility and relatively low emissions compared to coal. These generators operate on a Brayton cycle, where compressed air is mixed with natural gas and ignited to produce high-pressure hot gas. This gas expands through a turbine, causing it to spin. The turbine is then connected to a turbo rotor, which generates electricity as it rotates within a stationary component called a stator. To maximize efficiency, many natural gas plants employ a combined cycle gas turbine (CCGT) system. Within this configuration, the hot gases exciting the initial turbine are captured and used to heat water in a heat recovery steam generator (HRSG). The resulting steam then drives a second turbine using the Rankine cycle, generating additional electricity. This dual cycle approach significantly improves efficiency compared to a simple cycle gas turbine (SCGT). For instance, an SCGT might generate 300 to 400 megawatt of power, while a CCGT can achieve outputs closer to 600 megawatt with a lower heat rate. A critical metric for evaluating the performance of natural gas and coal generators is the heat rate, expressed in million British thermal units per megawatt hour, MMBTU per MWH. This measures how much fuel energy is required to produce 1 megawatt hour of electricity. A lower heat rate indicates higher efficiency. For example, a generator with a heat rate of 7 MMBTU per MWH requires 1,400 MMBTU of natural gas to produce 200 megawatt hour of electricity. Operators prioritize units with lower heat rates to minimize fuel consumptions and costs. And here comes the cost analysis. Operating a power plant involves significant financial considerations. The cost structure includes setup costs, that is the fuel and operational expenses incurred to building a generator online, or you may consider it as a fixed cost. The second one is variable cost or marginal cost, primarily driven by the heat rate of the unit and the price of fuel. For instance, natural gas or coal. The third one is external costs, factors like carbon pricing in regions with emissions trading schemes, like California's Cap and Trade program or the Regional Greenhouse Gas Initiative in the Northeast. Given these costs, power plant operators dispatch their units based on efficiency and market condition. Combined cycle units are typically used first due to their lower heat rates. During periods of high demand, less efficient peaker units may be activated, despite their higher costs. The financial rewards for operating a power plant can be substantial, though they depend heavily on regional power prices. For instance, a 100 megawatt unit running at full capacity for 16 hours per day at $60 per megawatt hour could generate approximately 100,000 US dollars in gross revenue daily. However, these earnings must offset significant capital expenditures, operational costs, and regulatory compliance expenses. Power plants are complex systems that combine engineering ingenuity with economic strategy to meet the energy demands of modern society. Whether it's through natural gas turbines, renewable sources like wind and solar, or traditional coal-fired plants, each generator type contributes uniquely to the energy mix. Understanding how power plants operate from the engineering principles to their cost structures provides valuable insights into the broader energy ecosystem. As global energy markets continue to evolve, driven by advancements in technology and policy shifts towards sustainability, power plants remain at the forefront of this transformation. The development of a power plant is a complex and multifaceted endeavor that involves several critical stages, each demanding careful consideration and strategic planning. Here, the author provides a professional overview of the essential steps in building a power plant, from initial scoping to operation, with a focus on the key elements that influence each phase. The first step in building a power plant involves defining the scope and ambition of the project. This includes determining the type of plant, be it natural gas, coal, renewable energy, or nuclear, and its intended capacity. Each type of plant comes with its own set of construction costs and operational considerations. Additionally, the choice of fuel type may dictate your potential locations for a plant, such as proximity to natural gas pipelines for gas plants. Another important aspect of scoping is understanding the purpose of the plant. Whether the intention is to sell power to the grid or use it for specific applications like data centers, Each scenario presents unique challenges. For instance, connecting to the grid involves navigating the interconnection queue, a process that requires careful coordination with the independent system operator ISO to manage grid stability and congestion. Site selection is such a critical phase that requires thorough analysis and evaluation. The sustainability of a location is often constrained by various factors, including existing land use, environmental regulations, and potential conflicts with other industries or product areas. For example, projects in roaming must consider conflicts with oil and gas operations and adhere to environmental projections, such as the Greater Sage Growth Plan. To streamline site selection, developers can utilize geographic information systems (GIS) files to identify potential conflicts and ensure compliance with local regulations. Engaging with regional organizations like the Energy Facilities Site Evaluation Council (EFSEC) can provide additional oversight and validation of the site suitability. Securing financing for a power plant is a substantial undertaking, particularly given the high cost associated with construction and equipment. Developers often rely on a combination of equity sales and debt financing to fund their projects. A key component of securing loans is demonstrating stable cash flows through long-term contracts, such as power purchase agreements (PPA) with anchor tenants, or alternative financial instruments like hit rate call options (HRCOs). The financial health and reliability of counterparties play a crucial role in determining interest rates and loan rates and loan terms. Lenders assess the risk associated with these counterparties to establish appropriate interest rates, typically calculated as a margin above the secured overnight financing rate (SOFR). There is the overnight interest rate set by the banking industry. The construction phase is executed by engineering, procurement, and construction EPC contractors who are responsible for the physical build-out of the plant. This stage involves sourcing materials, many of which may be in short supply due to global demand and manufacturing backlogs. Innovative solutions such as repurposing jet turbines for gas operations or importing parts from international suppliers may be necessary to address procurement challenges. For data centers, additional infrastructure requirements include internet connectivity, GPU rack installations, and cooling systems to support operational efficiency. Upon completion, the power plant enters the operational phase, where it can either be self-operated or sold to an independent power producer (IPP). At this stage, the plant's revenue streams become more predictable, allowing for refinancing opportunities at more favorable interest rates compared to initial construction loans. The operational success of the plant depends on undertaking market dynamics and effectively managing power prices in coordination with the ISO. For data centers, securing fixed returns through long-term agreements ensures financial stability and profitability. Building a power plant is a highly intricate process that demands meticulous planning and execution across multiple stages. By understanding and addressing the challenges inherent in scoping, site selection, financing, construction, and operation, developers can successfully navigate the complexities of power plant development and contribute to meeting the growing energy demands of modern society. In the ever-evolving landscape of energy production, the Homer City Generating Station stands as a testament to the challenges and opportunities inherent in transitioning from traditional coal power to more sustainable and economically viable energy sources. This case study delves into the historical significance, economic considerations, and future prospects of this pivotal project located in Pennsylvania. Homer City Generating Station, historically a significant coal-fired power plant with a capacity of 2 gigawatts, comprised 3 units dedicated to coal combustion. Situated within the Pennsylvania, Jersey, Maryland PJM power market, the plant faced increasing economic pressures as natural gas emerged as a more cost-effective alternative. The competitive landscape saw coal units with heat rates around 10 being overshadowed by more efficient natural gas units with heat rates between 6 and 7. Consequently, Homer City's coal units experienced reduced operational frequency, culminating in the plant's closure in 2023 after approximately 50 years of service. Despite this closure, the story of Homer City is far from over. The site is undergoing a comprehensive redevelopment to transform into a formidable 4.4 gigawatt natural gas plant, a project of monumental scale considering that a nuclear plant is typically regarded as large as 1 gigawatt. With an estimated construction cost of $10 billion US, this new facility, this amenity is envisioned as a cornerstone for a data center campus. EQT Corporation has been secured as the natural gas partner for this ambitious venture, while the anchor tenants have yet to be publicly announced. This strategic decision may be influenced by ongoing financing efforts or permit finalizations. Premature announcements could inadvertently grant leverage to potential tenants or create unfavorable public narratives during the permitting process. As of now, Homer City has successfully obtained critical permits necessary for construction, including an air quality permit approved by the Pennsylvania Department of Environmental Protection (DEP) in November 2025. Additionally, a waterway permit has been secured, enabling the active involvement of approximately 1,000 workers in the construction phase. Looking ahead, speculation abounds regarding potential delays in the project's timeline. However, the planned natural gas units are designed to achieve exceptional efficiency with a heat rate around 6, positioning the project for significant profitability once operational. The financial stakes are high, necessitating meticulous execution to avoid costly setbacks. In conclusion, the redevelopment of Homer City Generating Station exemplifies the dynamic interplay between historical energy infrastructure and modern economic imperatives. As it transitions from coal to natural gas, this project not only underscores the shifting energy paradigm, but also highlights the intricate considerations involved in such large-scale transformation. The successful completion of this endeavor could serve as a model for similar projects worldwide, demonstrating the viability and necessity of adapting to evolving energy landscapes. The rapid expansion of artificial intelligence (AI) and its associated computational demands has led to a surge in the need for data centers worldwide. These facilities require immense amounts of power, placing significant strain on local energy grids and prompting governments, private entities, and energy providers to reevaluate their strategies for meeting this growing demand. Just like in the era of proof of work Bitcoin mining. In this article, the authors explore the multifaceted challenges posed by data center expansion, analyze government responses, and propose actionable solutions to address the pressing infrastructure needs. The impact of data centers on regional power grids varies significantly depending on location, contract durations, and surrounding infrastructure. While AI-driven demand can justify the construction of new power generation facilities, the economic feasibility of such projects depends heavily on these factors. In some regions, data centers have proven to stabilize electricity prices by absorbing excess power during periods of low demand. For example, share fixed costs. Data centers can reduce costs for ordinary ratepayers by sharing expenses associated with transmission and distribution infrastructure. Price stabilization. By functioning like batteries, data centers can help stabilize daytime electricity prices, particularly in regions with high renewable energy penetration. And the third is the renewable integration. In areas like Texas, where wind turbines occasionally drive electricity prices negative, increased demand from data centers can improve overall grid welfare. However, these benefits are highly location dependent. Improperly set data centers can congest transmission lines, exacerbate resource adequacy challenges, and lead to significant price spikes in capacity markets, as warned by the North American Electricity Reliability Corporation and (NERC). Governments have approached the issues of data center expansion with caution, often expressing concerns about its impact on ordinary electricity ratepayers. Legislative responses range from neutral pledges to more aggressive proposals. Namely, Ratepayer Protection Pledge. The White House has issued a non-binding statement outlining its intent to mitigate the impact of data centers on electricity costs. And the Power of the People Act. This congressional proposal seeks to establish new rate classes, interconnection queues, and Federal Energy Regulatory Commission (FERC) rules to manage data center growth. However, it has struggled to gain traction. In extreme cases, some regions have even proposed moratoriums on data center construction. While many of these initiatives have failed, a few have succeeded in temporarily halting expansion. One innovative approach to managing data centers' energy consumption has been the concept of off-grid or independent grids. For example, in New Hampshire, local governments have proposed separating data centers from the main grid entirely. While this eliminates their direct impact on grid demand and fixed costs, it can still indirectly affect energy markets by increasing fuel prices for natural gas or other resources. Another emergent concept involves strategically placing GPU clusters worldwide to leverage regions with the cheapest power at any given time. While this approach is feasible for inference tasks, where trained machine learning models are used, it is less viable for training tasks that require solo co-located GPUs and gigawatt-scale power. These solutions highlight the importance of flexibility and innovation in addressing the unique energy needs of modern data centers. The financial dynamic of meeting AI-driven power demand are complex. While some major AI labs are confident in their ability to meet their power needs in the medium term by 2028, the immediate demand is far more pressing. This creates challenges for underwriting new power plant development. Deals like SpaceX agreement with Reflection offer high optionality but short durations, like a 90-day termination clauses, with lucrative estimated at $5,000 per megawatt hour with GPUs included. Such arrangements are difficult to finance due to their limited time horizon. For long-term commitments, in contrast, Anthropic's $19 billion lease with TeraWulf spans 20 years for 400 megawatts starting in 2027, with an implied revenue of $271 per megawatt hour. Excluding GPUs but including infrastructure. This structure provides greater financial stability but requires significant upfront investment. The challenge lies in balancing short-term demand with long-term infrastructure development. Delaying the retirement of inefficient coal plants may be economically justified in some cases, despite environmental consequences and carbon taxes. To effectively meet the growing energy demands of data centers while minimizing negative impacts on ratepayers and the environment, several strategic actions should be considered. The first is to accelerate development of power plants. The immediate need for additional energy generation requires a temporary relaxation of resistance to less efficient fuel sources like coal or diesel. This should be paired with expedited site selection with an engineering, procurement, and construction EPC processes for natural gas plants, incentivizing EPC firms by granting partial ownership stakes in power plants could further enhance development speed. The second is to invest in transmission infrastructure. Delivery constraints remain a critical bottleneck in many regions. For instance, upstate New York's abundant nuclear power cannot reach Manhattan due to inadequate transmission capacity. State and federal agencies must prioritize permitting and funding for new transmission lines. The third is to leverage private equity. Given the short-term nature of much AI-driven demand, private equity funds with shorter lifespans may serve as optimal vehicles for financing rapid infrastructure development. And the fourth strategy is optimizing market strategies. Effective market trading will also be essential in managing power supply and demand dynamics. Predicting how various stakeholders respond to market signals can yield significant profits while ensuring grid stability. The expansion of data centers driven by AI demand represent both challenges and opportunities for energy infrastructure development. By adopting innovative solutions such as separate grids, long-term financing structures, expedited permitting processes, and strategic investments in transmission systems, stakeholders can mitigate negative impacts while capitalizing on growth opportunities. As this sector continues to evolve, collaboration between governments, private entities, and energy providers will be crucial in ensuring sustainable progress that benefit both ratepayers and industry leaders alike. Let's take a short break and then come back to how to trade and how to manage our financial in the electricity power trade in our next session. The power markets in the United States are a complex and dynamic market system driven by regional differences in grid topology, field types, regulatory frameworks, and market rules. For energy traders, understanding these nuances is essential to navigating the markets effectively. This article provides an overview of the major independent system operators (ISOs) in the US, their unique characteristics, and how these impact power market dynamics. The US power grid is a vast network of interconnected nodes or buses, each with its own price determined by supply and demand conditions at that specific location. However, rather than trading in individual nodes, market participants typically focus on stalls, which are regionally averages of these localized prices. The methodology for calculating these averages varies across ISOs. ISOs are responsible for managing the grid within their jurisdiction. They collect offer curves from power generators and then anticipated demand from load-serving entities, running complex optimizations to determine efficient power prices. While the overarching goal of these optimizations is consistent across ISOs, the specific rules and methodologies differ from one ISO to another. It is also important to note that wholesale electricity prices set by ISOs represent the cost of power generation. Retail electricity prices, which consumers pay, include additional costs for transmission, distribution, and utility overheads. These added costs often constitute a significant portion of a consumer's total electricity bill. And let's take a look at the Pennsylvania, Jersey, Maryland PJM interconnection. The PJM interconnection is the largest and most liquid power market in the US, often considered the original ISO. Despite its name, PJM covers a wide area beyond Pennsylvania, New Jersey, and Maryland, including parts of Illinois, Kentucky, Michigan, and Virginia. The region is notable for its role as a hub for data centers, particularly in Virginia, which is often referred to as the data center capital of the US. South of PJM lies a region encompassing states like Georgia and Florida, which do not operate organized wholesale markets. Instead, these areas rely on regulated utility companies that charge a fixed margin over their cost. While this model provides stability, it lacks incentives for cost cutting and efficiency improvements. Next is the Miscellaneous Independent System Operator (MISO). MISO shares a border with PJM and facilitates energy flows between the two regions. A key trend in MISO is the retirement of coal-fired power plants in favor of renewable energy sources like wind. Despite this shift, coal has remained competitive with natural gas in recent years due to its profitability under certain market conditions. MISO is particularly known for its significant wind generation capacity, making it a focal point for renewable energy development. States like Indiana, Illinois, and Michigan have become popular locations for new data center projects due to their access to affordable and renewable energy resources. California Independent System Operator (CAISO) it manages the grid in California, a state known for its progressive renewable energy policies. The market is divided into North Path 15 (MP15) and South Path 15 (SPF15), connected by a major transmission line known as Path 15. A smaller region known as ZP26 is also part of CAISO but sees less trading activity compared to MP15 and SP15. California's energy mix is distinct in that it excludes coal entirely. The state relies heavily on renewables such as solar and wind, along with nuclear and natural gas generation. Behind the meter, solar installations further reduce demand on the grid as they directly serve household energy needs. Additionally, California imports significant amounts of hydroelectric power from the Pacific Northwest, where generators operate under a regulated rate of return model. Electricity Reliability Council of Texas (ERCOT) operates an independent grid that is largely isolated from the rest of the U.S., with only limited high-voltage direct current (HVDC) connections to neighboring regions. This isolation allows Texas to operate under its own regulatory framework, independent of the Federal Energy Regulatory Commission (FERC). This is not the FERC we mentioned in blockchain. This is not the Ethereum protocol. Insertion. ERCOT is known for its highly deregulated market structure and extreme price volatility. Prices can soar to $9,000 per megawatt hour during periods of high demand, or plummet into negative territory during periods of excessive wind generation. Negative pricing occurs when subsidies like the production tax credit incentivize wind turbine to continue operating even when there is insufficient demand to absorb the generated power. This market dynamic has attracted energy-intensive industries such as data centers and cryptocurrency mining operations to Texas. Other ISOs across the US include Southwest Power Pool SPP, primarily known for its significant wind energy production. New York ISO NYISO features unique challenges due to Manhattan's high electricity demand and limited ability to transport upstate nuclear power to the city. And ISO New England (ISO-NE) faces seasonal constraints on natural gas supply during winter months, occasionally turning to oil as an alternative fuel source. The US power markets are as diverse as the regions they serve. Each ISO operates under unique conditions shaped by geography, fuel availability, regulatory frameworks, and market dynamics. For those looking to engage in energy trading or better understand electricity pricing in their region, exploring ISO-specific resources is an excellent starting point. By delving deeper into the intricacies of each market, participants can gain vulnerable insights into this vital sector of the economy. And let's move on to the case study in Avatar. Avatar's energy market provides a fascinating case study in the complexities of energy-only market structures and the challenges posed by aggressive renewables growth. Often called the Texas of Canada, Avatar shares many similarities with its southern counterpart, including a reliance on natural gas for power generation and an energy-only market design that eschews capacity payments. However, Avatar's unique approach to managing inefficiencies and integrating renewable energy offers valuable insights into the dynamics of modern electricity market. Energy-only markets, such as those in Avatar and Texas, fundamentally rely on scarcity pricing to ensure reliability and incentivize generators to cover their fixed costs. Unlike capacity markets, which provide periodic payments to generators simply for existing and being available when needed, energy-only markets aim to achieve efficiency by letting prices dictate whether a generator should remain operational. So here are two entirely different market structures. In traditional marginal cost pricing, the clearing price is set by the cost of production. Cost of producing the last unit of power required to meet demand. This is just a basic basic economic concept. While this system rewards efficient suppliers such as solar plants with substantial profits, it poses significant challenges for less efficient generators. These units often operate only during times of scarcity, earning just enough revenue to cover their marginal costs without generating profit. This creates a missing money problem, where generators struggle to recover fixed costs and achieve a reasonable rate of return. To address this issue, arbitrage allows generators to earn scarcity rent, which is an excess above marginal cost during periods of high demand. However, arbitrage imposes a cap on maximum prices at 1,000 Canadian 1,000 CAD, 1,000 Canadian dollars per megawatt hour, which is set to increase in the coming years. This cap ensures some level of price stability while still allowing scarcity pricing to incentivize reliability. In contrast, Texas employs a system of price adheres based on the probability of lost load during periods of scarcity, with prices potentially reaching as high as $5,000 per megawatt hour during blackouts. Arbitrage is also grappling with the challenges of integrating renewable energies into its grid. The province has seen significant growth in renewable generation, resulting in deep penetration during daytime hours. This has led to the emergence of the duck curve phenomenon, where total demand minus renewable generation is low during the day and spikes in the evening as people return home and energy consumption rises. During daytime hours, abundant solar and wind generation often drives prices down to their $0 floor, making it uneconomical for combined cycle gas turbines (CCGTs) to operate continuously. However, these natural gas units are still critical for meeting evening demands when renewables alone cannot suffice. The need for flexible generation during peak evening hours has led to increased reliance on less efficient simple cycle gas turbines (SCGTs), which are cheaper to start up and shut down quickly but operate less efficiently than CCGTs. The growing disparity between daytime and evening prices in Alberta highlights the challenges posed by renewables growth in energy-only markets. Batteries have begun to play a crucial role in addressing this issue by purchasing cheap daytime power and selling it out during evening peaks. This ability to both buy and sell power has helped flatten Alberta's price curve, improving market efficiency and reliability. The combination of scarcity pricing, renewables integration, and battery storage has led Alberta's market to undergo aggressive restructuring. The province approach underscores the trade-offs inherent in energy-only market designs. While these markets aim to achieve efficiency by avoiding capacity payments, they must contend with challenges such as price volatility, the missing money problem, and the integration of intermittent renewable energy sources. Alberta's experience also highlights the importance of innovation in addressing these challenges. The emergence of battery storage as a key player in mitigating price disparities demonstrates how technological advancements can complement market design to enhance reliability and efficiency. Alberta's energy market serves as a compelling example of how market structure decisions can have profound implications for grid reliability, generator economics, and renewables integration. By relying on scarcity pricing and embracing an energy-only model, Alberta has chosen an approach that prioritizes efficiency while navigating the complexities of high renewable penetration. As other jurisdictions consider their own paths forward, Alberta's experience offers valuable lessons in balancing market efficiency with the realities of modern energy demands. The production cost model is a cornerstone of power market operations, particularly in regions governed by independent system operators (ISOs). This model serves as a critical tool for determining power prices and optimizing generation resources to meet demand efficiently. In this article, the author explored the theoretical foundations, practical applications, and key considerations of the production cost model, providing a comprehensive understanding of its role in modern energy systems. The production cost model closely aligns with the power pricing methodologies employed in ISO regions. It outputs locational marginal prices, LMPs, which represent the cost of delivering an additional unit of electricity to a specific location. Power markets operate on two primary timelines: the day-ahead market, calculated 1 day prior to delivery, and the real-time market, updated every 5 minutes on the day of delivery. In essence, the model is designed to minimize the total cost of production across the system, while adhering to various economic operational constraints. By determining how much power each generator should produce, it ensures that supply meets demand at the lowest possible cost. This optimization process is central to maintaining grid reliability and economic efficiency. The theoretical foundation of the production cost model lies in economic principles and optimization theory. A key assumption is that power demand is largely inelastic, meaning that consumers are willing to pay any price for electricity. While this assumption simplifies calculation, it does not account for demand-side programs like demand response DR, where consumers are incentivized to reduce usage during critical periods. 個意思都係假設咗用戶嗰邊嘅需求係非彈性，即係無論你要俾幾多錢，花幾多錢，你都願意去買呢啲電。咁事實上有啲人係真係會因為電費貴慳電用少啲電。From an economic perspective, markets aim to maximize societal welfare, the aggregate benefit derived by consumers and producers. Welfare is achieved when goods are traded at prices that reflect their true value to consumers and producers. In power markets, this efficient price is the one that maximizes total welfare, represented by the area between supply and demand curves. 眾所周知啦，所謂嘅福利其實就係呢個供需曲線之間差出嚟呢個面積啦。半邊三角形就係消費者福利，半邊三角形就係生產者福利，而最大化福利就係最大化呢個面積。個意思就係當呢啲嘅商品係喺最反映到佢哋真實價值嘅價格去成交。However, when power demand becomes highly inelastic, the demand curve approaches a vertical line, leaving little room for price adjustments. In such scenarios, minimizing production costs becomes the primary lever for optimizing welfare. This is achieved by selecting generators with the lowest cost while adhering to physical and operational constraints. 我頭先都講咗啦，當能源嘅需求係非常之冇彈性嘅時候，咁樣需求曲線就會趨近於一條直線，一條垂直線。喺呢個情況之下，你要去優化福利，其實就係等介於你去最小化生產嘅成本。咁所以要實現最大化福利，其實就係揀一啲發電機，揀一啲最低成本嘅發電機，即係喺符合運作同埋物理限制之下嘅最低成本嘅發電機。The production cost model is formulated as an optimization problem. The objective is to minimize the total system cost, with the constraints including balance constraints. Supply must equal demand at each location. Transmission constraints. Power flow through transmission lines must remain within their rated capacity. Generator capacity constraints. Generation output must lie within permissible limits, from 0 MW to maximum capacity. and reliability constraints. Additional requirements such as reliability reserves must be met. Optimization software like Gurobi or CPLEX is used to solve this kind of problem, outputting generation levels for each unit while accounting for startup costs, marginal costs, and transmission costs and transmission losses. The resulting LMPs are derived from the Lagrange multipliers associated with balance constraints, representing the marginal cost of supplying an additional megawatt hour at a specific location。咁其實就係大家細個學優化嘅時候用嘅呢個 Lagrange multiplier。係 set 嗰啲 gradient。 setting the gradient as 0 to calculate the extreme points. Electric grids require continuous balancing as consumer behavior fluctuates throughout the day. Ancillary services play a vital role in maintaining this balance by providing flexible resources like batteries or demand-side assets. They can respond quickly to changes in supply or demand. These services are compensated at premium rates due to their critical role in grid stability, just like the arbitrages in liquidity pools. Power plants need advance notice to plan operations effectively, including staffing and fuel procurement. The day-ahead market addresses this need by allowing participants to submit offers and forecasts for the next day's demand. Prices are computed based on these submissions, creating a financial market that settles before physical delivery occurs. On the day of delivery, real-time market prices are recalculated every 5 minutes to account for updated conditions such as weather-driven demand changes or unforeseen outages. Weather remains a significant driver of real-time market volatility, influencing both electricity consumption and fuel prices. Several factors add complexity to the production cost model. Startup costs mean that generators incur expenses when starting up but not producing electricity, known as no-load costs. The minimum runtime requirements means that certain units must operate for a minimum duration once started. There are also binary decisions determining whether generators should be turned on or off transforms the optimization problem from a linear program into a mixed integer program, significantly increasing computational complexity. To simplify this process, ISOs often separate unit commitment, deciding which generators to activate, from economic dispatch, determining generation levels for active units. Unit commitment is particularly challenging due to its binary nature. Binding constraints are critical factors that influence power supply, power prices. Consider a simple two-node example where there is a power line with a maximum of 50 megawatt. If node A has a marginal cost of $100 per megawatt hour and node B has a marginal cost of $10 per megawatt hour, and A demands 10 megawatt hour of power, the production cost model will select B as the supplier and transmit power over the time. The price at A remains $10 per megawatt hour due to B's lower cost. However, if demand as A increases to 60 megawatt hour, node B will produce up to its maximum capacity while saturating the transmission line at 50 megawatt hour. The remaining 10 megawatt hour must be supplied by A at $100 per megawatt hour, causing a sharp increase in prices at A due to the binding constraint on the transmission line's capacity. Binding constraints are thus pivotal in driving price variations across locations. Production cost models can be extended beyond daily operations to compute forward prices for longer periods, such as 3-month strips commonly traded in power markets. By averaging daily price estimates over the desired time frame, market participants can derive forward prices for hedging purposes. Large energy consumers, such as data centers operated by major technology companies, often engage in hedging strategies to lock in favorable rates and mitigate exposure to price volatility. The production cost model is an essential tool for ensuring efficient and reliable operation of modern power grids. By leveraging optimization techniques and economic principles, ISOs can balance supply and demand while minimizing costs and maximizing societal welfare. Despite its complexities such as unit commitment challenges and binding constraints, the model remains indispensable for managing electricity markets effectively. As power systems continue to evolve with increased renewable integrations and demand-side participation, the production cost model will remain central to achieving operational excellence and economic efficiency in energy markets. Forecasting power prices is a complex and computationally intensive task, often requiring the use of intricate production cost models. These models incorporate numerous variables such as generation operations, demand fluctuations, transmission constraints, and market conditions. However, solving these models in their entirety can be infeasible, especially when evaluating a wide range of scenarios. This website dwells into the practical approximations commonly employed to make power price forecasting more tractable and highlights their applications, benefits, and limitations. The previously mentioned production cost model at its core is designed to simulate the operational decisions of power systems. It calculates the cost of generating electricity based on factors such as fuel prices, generator efficiencies, and operational constraints. However, the full version of this model also requires solving for unit commitments. Decisions about which generators should be online or offline, making it a combinatorially complex problem. When forecasting power prices, analysts need to consider a variety of scenarios. These scenarios may include variations in demand due to unpredictable factors like weather, unexpected generator outages, or transmission line failures. Running a full production cost model for thousands of scenarios is computationally prohibitive. As a result, approximations are often used to simplify the modeling process without sacrificing too much accuracy. Common approximations in power price modeling include continuous relaxation. Actually, this is quite a common technique in premature step of linear programming. If you are interested in programming, you may consider purchasing Weebearn team's financial courses. We've taught a little bit of linear programming in our FanArt live streaming, and also we offer linear programming education for financial education. And you may also see our course list during conventions or cosplay events. Let me share the previous live streaming. We've introduced a little bit about linear programming. Besides money management in supply chain management or creating electricity power, this linear programming or integer programming is also widely used in prediction market, especially in combinatorial arbitrage. And if you are interested in researching prediction market money management strategies, feel free to join our Discord channel and discuss with us. This was the brief introduction to integer programming in our previous live streaming. Yeah, we've talked about the technique of continuous relaxation. One of the most widely used simplifications is the assumption that generators are not strictly on or off. Instead, they can operate at fractional levels or even continuous levels. This approach, known as continuous relaxation, significantly reduces the combinational burden by allowing generators to operate at intermediate levels of output or any arbitrary levels of output. While this assumption deviates from physical reality, it provides a reasonable approximation for a large-scale model. The second technique is exogenous interchange flows. In certain regions, such as MP15 in the California Independent System Operator (CISO) market, analysts may already have a good understanding of the inter-regional power flows. For instance, it is often known that a specific amount of power will be imported from the Pacific Northwest (PNW) or other neighboring zones under certain conditions. By treating these flows as exogenous inputs rather than solving for them explicitly, the balance equation can be simplified to supply equals net demand plus net storage. This approach reduces computational complexity while providing a reasonable estimate for regional price forecasting. The third approach is simplified battery dynamics. Batteries play a crucial role in modern power systems by storing energy during periods of low demand and discharging during peak demand. While real-world battery behavior can exhibit variability, such as partial charging during daytime peaks, simplifying assumptions can streamline modeling efforts. For instance, analysts often assume that batteries charge during the daytime when prices are low or close to zero and discharge in the evening when prices spike. This simplification captures the general behavior of batteries without delving into minute operational details. Once interregional flows and storage dynamics are fixed, determining the marginal cost of supply becomes the next critical step. This involves estimating demand, often through statistical methods like linear regression on temperature data, and ranking generators by their marginal cost in ascending order, a process known as merge order dispatch. Merge order dispatch by means of merge order dispatch, the marginal cost of the last generator required to meet demand determines the market price due to marginal cost pricing principles, similar to the limit order book LB in the financial market. And finally, the losses incurred during power transmission are inherently nonlinear, depending on the amount of power flowing through transmission lines. However, accurately modeling these losses can be computationally challenging. As a result, many analysts either ignore transmission losses entirely or approximate them as a fixed percentage of power loss. While this simplification introduces some error, it often strikes a reasonable balance between accuracy and computational efficiency. While these approximations make large-scale power price modeling feasible, they come with inherent risks and limitations. Inaccurate flow assumptions about interregional flows can lead to significant errors in price forecasts. Some regions have highly dynamic and unpredictable flow patterns that cannot be easily approximated. And also, real-world battery operations are influenced by several factors that these models may overlook, such as intraday price volatility or unexpected changes in demand. And this poses a risk in oversimplified battery dynamics. The simplified models often ignore generator startup costs, which can significantly impact unit commitment decisions and alter dispatch outcomes. Also, Many regions have reliability requirements mandating that a certain portion of demand must be met locally rather than through imports. Simplified models may fail to account for these constraints. Last but not least, factors such as behind-the-meter solar generation, growing electricity demand from data centers, and emerging loads like Bitcoin mining are often excluded from these approximations, but can have substantial impacts on price dynamics. Critical approximations are indispensable tools for power supply forecasting at scale. Techniques such as continuous relaxation, exogenous interchange assumptions, simplified battery dynamics, mirrored order dispatch, and linearized losses help reduce computational complexity while providing reasonable accurate results for most scenarios. However, these approximations come with trade-offs and may not capture critical details in certain contexts. For energy traders and analysts, understanding both the strengths and limitations of these simplifications is essential for making informed decisions in dynamic and complex electricity markets. While simplified models may not capture every nuance of power systems, they offer valuable insights that align closely with real-world outcomes and enable effective decision-making in competitive markets. The dynamics of power trading are complex, involving a variety of financial instruments and strategies that enable market participants to manage risk and optimize their operations. Whether you are a trader, a data center operator, or a power plant manager, understanding the mechanisms of power markets is essential for making informed decisions. Here we delve into the key types of power trades, the process of clearing and settlement, hedging strategies, congestion trading, and spreads, offering a comprehensive guide to navigating this intricate market. Power markets operate on several trading mechanisms, including forwards, spreads, and combinations of financial instruments. These tools allow participants to lock in prices, mitigate risk, and secure predictable economic outcomes. A common practice in power trading is the differentiation between on-peak hours and off-peak hours. On-peak hours, when power demand is highest, tend to be more actively traded across independent system operators (ISOs). Power trading occurs primarily in two small markets, the day-ahead DA market and the real-time RT market. These markets are managed by ISOs and differ in timing and operational dynamics. Day-ahead market (DA) the DA market clears 1 day prior to the actual consumption of power. For instance, trades for the 2nd of July are finalized on the 1st of July. Once the DA market clears, all participants know their financial obligations or receivables based on the agreed upon prices. Unlike the DA market, the real-time market (RT) operates in near real time, updating every 5 minutes as power is consumed. The RT market accounts for discrepancies between forecasted and actual energy consumption or production. Any additional megawatt hours MWH consumed or produced are settled at the prevailing RT price. For power plants, accurate forecasting is critical. If a plant produces precisely what it committed to in the DA market, it receives the DA price. However, deviations from this commitment result in settlement at RT prices, which can vary significantly. Hedging is a cornerstone of power trading, offering businesses a way to mitigate price volatility and achieve predictability in their energy costs. A widely used hedging instrument is the forward contract. A forward contract allows participants to lock in a specific price for future electricity consumption or production. For example, an industrial facility expecting to consume 300 MW of power daily over a year might purchase a 1-year forward strip at $50 per megawatt hour. While this contract does not involve the physical purchase of power, it creates equivalent economic exposure by settling the difference between the forward price and the eventual DA spot price. On the day of consumption, the business still needs to purchase power from the DA spot market. If the DA price is lower than the forward price, the company will incur a loss on its forward contract but benefit from lower spot prices. Conversely, if the DA price is higher, say $100 per megawatt hour, the profit from the forward contract offsets the higher spot cost. In either case, the effective cost remains close to $50 per megawatt hour. Power producers such as natural gas plants also employ hedging strategies to stabilize their revenues. For instance, they may sell forward strips on power prices while simultaneously purchasing forward strips on natural gas prices to offset fuel cost volatility. This dual approach ensures a more predictable profit margin. Transmission congestion plays a pivotal role in power pricing. When transmission lines reach their capacity limits, regional price spikes often occur. This phenomenon creates opportunities for basis trading, a strategy involving the price differential between two locations. A basis trade involves buying power at one location while simultaneously selling it at another. This trade assumes that congestion will cause the price difference spaces between these locations to widen. Financial transmission rights (FTRs) are commonly used instruments in such trades, providing payouts based on congestion costs between two nodes. Spreads are another critical concept in power trading. A spread involves buying one instrument while selling another, creating opportunities for risk management or speculative profit. The spark spread is among the most popular spreads in power markets. It involves buying a forward strip for electricity while selling a forward strip for natural gas. This spread is particularly relevant for natural gas-fired power plants aiming to hedge their operations. The value of a spark spread is calculated as power price minus heat rate times natural gas price. For example, a plant with a 7 heat rate would sell a 7 heat rate spark spread to hedge its position against fluctuations in natural gas prices. Similar to spark spreads, dark spreads apply to coal-fired power plants and involve the relationship between coal prices and electricity prices. These spreads are useful for analyzing coal plant profitability or hedging against coal price volatility. Time-based spreads involve buying and selling electricity contracts across different time periods, such as hours or months. Analogous to the vendor spread strategy in options trading. To capitalize on temporal price differences, while there are various types of time-based spreads, spot spreads remain particularly significant for operators of data centers and power plants. The future of power trading represents both challenges and opportunities. As demand for electricity grows, driven by expanding data centers and other industrial consumers, market participants must grapple with questions about price impacts and resource allocation. Will new infrastructure drive prices up or down? How will increased demand affect grid efficiency? What role will less efficient power sources play in meeting these demands? The answers depend on numerous factors, including regional grid constraints, fuel prices, and policy developments. However, armed with an understanding of power markets and their associated trading strategies, stakeholders are better positioned to navigate this evolving landscape. For those with expertise in power trading and market dynamics, the coming year promised significant opportunity to shape and capitalize on this critical sector of the global economy. By mastering concepts such as forward spreads, congestion trading, and hedging strategies, business and traders can effectively manage risk and seize opportunities in this dynamic field. As always in power markets, success depends on preparation, analysis, and adaptability. And besides power market, I think this money management concept also applies to other kinds of market, including the downstream AI market itself. Again, Weebearn, we are a comprehensive money educational platform dedicated to nurture entrepreneurs, investors, and capitalists among secondary school students, cosplayers, and anime lovers. I'm also the chief executive and the director of the Weebearn VTubers Alliance, a decentralized autonomous organization focusing on supporting the development of aspiring virtual idols of the future generations. If you are a secondary school student or teenager looking to embark on a VTuber career, and you are passionate, join our Weebearn VTubers incubation program and auto agency. And also, if you enjoy this episode, please subscribe to Weebearn on YouTube and share our videos with your friends and classmates interested in anime, macroeconomics, gaming, cosplay, AI, technology, and options trading. We are committed to fostering a wealth management educational platform. Let me paste the link to my Google Doc of links, which we use to manage our wealth ourselves. You may also meet other anime lovers, entrepreneurs, partners, or seek collaborations within our international ACG community on Discord. Oh, by the way, tomorrow we are going to introduce the dialogue given by Liang Wenfeng in previous months. The recent paper published by OpenAI, there's the 10 advances in mathematics and theoretical computer science with aid of the new GPT Astra. And also the paper Learning to Replicate Expert Judgment in Financial Tasks given by Bridgewater AI Labs and Thinking Machines. Thank you. This is the end of our live stream. See you in tomorrow live stream. 本內容講係個人分享，講參考之用，並不構成要嘅銷售資料，由數為任何保證，亦不構成投資建議。專業意見業務之內與香港推廣任何加密貨幣投資嘅風險，投資標的價值可升可跌，過秒不一定可預期將來表現。就組織任何投資決定前，投資應參閱相關上市文件做風險評估，並諮詢專業意見。本內容無意總合所述證券或投資牽涉任何風險。本內容所述資料根據獨撚認為可靠的資料來源編製，為該等資料來源未經獨立核證，故不會就本內容為準確性或轉述，不需任何保證陳述或擔保。本內容無意向派發本內容即觸犯法例或規例的司法權區或國家的任何人士或勢力派發，亦無意供該等人士或勢力使用。